All right, hey guys, welcome to day number 3 of the 2022 third annual SOFA Summit. Oh, this last day is going to be amazing, action-packed day for you. So first off, we really want to thank our sponsor for today is CLOSETRAK, another title company that we work with, basically that and Delta Title Services, who sponsored last week. CLOSETRAK is owned by Greg Ziskin. He's the main attorney over there. They're an amazing team and give us also a great group discounted rate. And pass that on to you as the investors if you use their title services. And they're just amazing, have great customer service, and really look forward to having them as our sponsor today and feel honored to have them for that.
Yeah, we have a really great point of contact over at CLOSETRAK. Her name is Amber White. Great communication, and they're just one of the top notch. They do a really good job at digging into the actual paperwork, the title work, to make sure that they can get you a title policy so things just go smoothly in the future and that there's no liens or encumbrances on the title, and just make sure that things go well. So thank you so much to Greg Ziskin and CLOSETRAK and the whole team. Y'all are rock stars, and so appreciate you.
So let's kick you off today. We'll give you a brief summary of what's going to be happening today. So we're going to be going over a multifamily syndication. What is that? How you can participate in it? And what are the basics, ins and outs, and the vocab around that? Mark Hart will be helping you out learning about that. Then I'll be diving into a couple multifamily properties that we bought over 2 or 3 years ago and how now we've refinanced them and pulled out almost 80% of our initial investment. Over the past 5 years, we have bought over 750 multifamily doors spread across 6 or 7 different apartment complexes. So we're happy and hopefully humbled a little bit to share you a bit of our experience and how it's gone through that and share with you a little bit of that knowledge.
Definitely. Next up, we'll have another client testimonial so they can share their feedback and their advice for you as either a new investor or someone that's looking to scale. And then we also will dive into we'll have a conversation with Ramez over at the IRA Club out of Chicago, just how to take control of your retirement accounts and move those funds from the stock market into real estate and hard assets. And then finally, a very important topic is how to keep more of your money utilizing a 1031 exchange. If you currently own a property that has appreciated over the years and you're worried about paying capital gains tax, this is the session for you.
Yeah, guys, we just want to say thank you yet again for watching and supporting us. If you've invested with us or looking to do that, we appreciate you so much being here, and we feel really humbled to be working with you and that you trust a lot of your retirement money or a big portion of what you have with us. We try our best to do a good job for you to pick out good properties and have a great return on your investment. So we appreciate all your comments and everything. And speaking of which, whoever gives us the best comment or commentor, they will win a Yeti. Another way to win a Yeti is if you subscribe to our YouTube channel during this. The person who's new, we'll pick a random person and they'll get a Yeti. Another third way to win it is subscribe to our buyers list. Go to memphisinvestmentproperties.net and click join our buyers list and fill in your info, and one lucky winner will win this free Yeti.
Yeah, so that's awesome. So we'll be giving away these 3 Yetis at the end of the day here. We'll reach out to you. Super excited for the content that we have moving forward. And like Sean said, very humble, very grateful to have you for this third and final day. So hey everyone, Mark Hart here from MIP. Super excited to teach everyone about apartment syndication. So this is going to be a beginner's guide to what is an apartment syndication. And we want to go and touch on some of the key items that make up a syndication, right? What is it? What are the documents that are used? What are some of the structures that we see? Just so you can better be prepared for the future if you ever are interested in learning more about one of these types of investments.
So we do have a disclaimer that this is not an active offering, right? We are not trying to raise money. We do not have a deal that we are trying to invest in and buy currently. This is just for educational purposes only. We just are here to teach you the basics, teach you the building blocks of an apartment syndication, and would love to be able to touch base, personally after this webinar, if this is something that you have additional questions on or are even somewhat interested in. All right, so let's get started here. Sorry for my little camera. All right, we'll move that. So at the top here, the primary investment objective of the company is to acquire, finance, manage, and dispose of the property in such a manner as to provide its members with a return on their investment and to eventually sell or exchange it for another property, right? That's the textbook definition of what this syndication is and what the goal of the company is. And so now what does that actually mean, right? Well, here's a really great little picture here. So this is the structure of a typical syndicated group investment. And at the top, we have this nice little building, right? We focus on apartment buildings, but you can buy all different types of buildings. And so let's say we have a building here in Memphis, Tennessee, as an example, right? Well, what we're going to do is we're going to create a limited liability company. So a lot of great perks of having an LLC. Number one is the protection of liability. And then also we're going to name this company, this brand new company that we're starting, after the actual property itself. And this new company is going to go and buy this individual complex, this individual apartment building. Within this company that we're starting, at the bottom left, you'll see general partners, and the bottom right, you'll see limited partners, right? It goes by GP and LP. Those are the little slangs. So bottom left, general partner, that's going to be me. That's going to be my partners, Jim Reedy, Brad Reedy, Sean Taggy, so on and so forth. We're also called the sponsors, another nickname. We're just the ones that put in the majority or all of the sweat equity, right? We are here to put this all together, right? If it wasn't for us, there wouldn't even be an opportunity available. So we go out, we find it, we finance it, we manage it, we try to create a return on investment for our members. That is our job, right? It's very active. We are extremely involved in the day-to-day as a general partner. So we're here to operate the asset and the business plan that is set forth in this limited liability company. So we're here to contribute our expertise, right? That is one of our biggest assets that we actually have, right? You should have a sponsor that has done this before, that knows the market, knows real estate, and just understands how to provide a good return on investment from the asset class. The GP will also contribute capital, right? We can invest as well, right? We love investing. And so that's something where we should be able to put in a portion of the investment to buy the building, but not all. The general partner will receive fees and equity, so profit for doing this entire investment, assuming the asset performs. Then essentially, well, what's the point of having a limited partner then, you might ask, or why even bring in investors? It's because the goal is to go buy a large asset that's so big that I don't have the capital, I don't have the cash sitting in my checking account to personally be able to buy one of these deals ourselves. So what we do is we say, hey, why not pool our resources together, create a company, and bring in limited partners, where all the limited partners they're very passive. This is one of the most passive, hands-off. This takes very minimal time on the investor's side of things. So you're going to read over all the legal documents. We'll dive into those in a minute and say, you know what, I'm interested. So you're going to be an equity investor, right? You're going to have an actual ownership percentage of the asset. So it's kind of fun. You can say, oh, I own 3 doors out of the 100 units, right? If you own 3% of the company, it's got 100 units. Well, that's like owning 3 doors, right? So it's like owning 3 rental properties in theory. And so you will get a portion of the cash flow in the form of dividends. And you'll also get a portion of the equity when the asset is actually sold. So essentially, this partnership here, very simple way to think of it, put your single family cap on and you say, hey, here's a single family deal. Let's say you found a single family deal, but you don't have the money to buy it. Well, you bring in a partner and you split the profits, right? That's exactly what we're doing here, just on a high level, large scale with hundreds of units and a multi-million-dollar asset. So next up is, well, what are these legal documents that we're creating? And the first one and the most important one is the private placement memorandum. It also goes by a PPM. This document will tell the story of the overall investment. This is probably one of the most important documents for you to be able to become a master of. I recommend reaching out to, multiple companies and requesting their PPMs and just reading them entirely, because essentially every PPM is going to be a little bit different, right? No two PPM is going to be exactly the same. And so you want to be able to familiarize yourself with the terms inside of that PPM to see if it's a good investment for you. Legally, the PPM is the disclosure document required by the Securities and Exchange Commissions, the SEC. Now, this memorandum describes things such as the structure of the company, projected distributions to investors, compensations to managers, to us, the risks of investing, potential conflicts of interest, and a summary of how the company will actually be operated. So next up, right, operating is the operating agreement, or the OA. So this agreement describes how the company will actually be run. So legally, it is the governing document for the company operations and describes and details the rights and duties of the members, which is you as the actual investor, and the manager, which is myself, as the general partner. So this is more formal, right? How will meetings and votes of the members be conducted? How and when cash distributions will be made, where the company books and records will be kept, how disputes will be resolved, allocations and taxations of profits and losses, how the company will ultimately be dissolved. And the agreement is the contractual enforceable contract between the members and the managers as to the operation of the company. So there's a lot of similarities between the operating agreement and the private placement memorandum. So you will need to read both documents to really understand the pros and the cons of the individual investment or the company that you'd actually be buying into, essentially. And then one of the final documents is the subscription booklet, or the SB. And each investor must review, complete, and return the subscription booklet to the manager in order to invest legally. So this contains the qualifications and suitabilities to invest in the offering, right? Sometimes you need to be an accredited investor. Other times you need to be a sophisticated investor. So you need to fill that information out. The amount the investor is planning to invest, and then the managers, myself, acknowledgement of the investment, and it's essentially your receipt as well. So it's very, very simple to invest, right? You read the PPM, read the operating agreement, read all the marketing material. There's normally a PowerPoint presentation, right? Do your due diligence, ask as many questions as possible. But if you're ready to invest, you fill out the subscription booklet, sign it, wire in your money, and then you sit back and pray, right? You don't have any day-to-day operational obligations like you would on a single family turnkey, right? As a single family turnkey, you get to make the decision on, should I sell the asset this year or should I sell it next year? Who do you want the property manager to be? You get to make the decisions on what type of maintenance and deferred maintenance to fix, or what type to just wait and push out for the next year or two. But you don't have that here on an apartment syndication. With an apartment syndication, you're giving away your basically day-to-day rights to operate the company to the manager, right? To myself, because we've got the experience, and you are just looking for a way to passively invest, reduce the amount of time that you need. You don't want to create another side job. You don't want to be an active investor. And essentially, a lot of folks, they live 1,000 miles away, or they live in Australia, right? It's very difficult to buy an apartment building in Memphis if you live in Australia. So next up, you're going to see the formal names. This is called a Regulation D of the tax code, Rule 506C versus 506B. So there's two, and they're different. Very, very, very important. So 506C is in Charlie, which requires the manager to take reasonable steps to verify that each investor is an accredited investor. And so essentially what that means is you have to be accredited investor to be able to invest in the individual offering, right? You'll go to your CPA, or you can go to a company like verifyinvestor.com, and they can get you a nice formal letter that says that you are accredited. And the reason why companies choose 506C is because, let's say it was an active offering, well, then you could go online, you could go on Facebook or Instagram or Google Ads and on podcasts and say, hey guys, shout it from the rooftops, I've got a deal, I'm raising $5 million, who wants to invest with me right now? And you don't need to know who these people are, right? You are marketing to find new people, essentially, but you can all those new people must be accredited. So now the other option is a 506B as in boy, which allows you to accept accredited, but also up to 35 sophisticated investors, which is one that does not have as much of a net worth and income as an accredited investor, but is assumed to have the capacity to understand the fundamental aspects and merits of an investment in a company. So essentially, what that really means is, do you have a relationship, a prior relationship with us? So for, let's say you're a sophisticated investor, you don't qualify as an accredited investor, and you bought some single family turnkeys from us. That is a relationship, right? So now we can present a 506B as in boy opportunity to you because we met based off the single families, but now we are sharing another opportunity, and you can actually invest in that deal. So that's the benefit of the 506B. Now, the con is that the 506B is, we cannot go on podcasts and we cannot go on webinars like this and say, I have a deal, I want to raise money, right? You cannot do that in a 506B. That's what the 506C is for. So for accredited investor, and you can Google the qualifications, there's multiple to be able to see if that is you or not. Next up is going to be the manager versus the member, right? And pretty simple, the manager is the general partner, right? That is us. We make the investment decisions on behalf of the company, right? We're the ones that are doing essentially all the work to make sure that we can create a profit and a return on investment for everyone involved. Then the member, which is you as the limited partner, well, the company will sell units or interests to investors. So you're actually going to buy these units or interests at a set price. And that allows the company to raise capital. So we can have the organization of the company to pay for property expenses, including the down payment, due diligence, loan fees, closing costs necessary for acquisitions of the property and repairs and maintenance. So in theory, the members, the limited partners, they bring the money. The managers, general partners, ourselves, we do all the work, and then we split the profits, right? Pretty great relationship between the two. Next up, right? Well, what's in it for you, right? As the limited partner, as the member, why even invest? So number one is you'll get cash flow from distributions of operations. So cash distributions from operations. So meaning we buy the asset, we own the asset. Now you're going to get, assuming it's available, of course, distributions. Could be monthly, could be quarterly, everything depends, right? So number one is going to be something that you might see, a buzzword called a preferred return. And a preferred return, think of that as just simple cash flow, right? After all the expenses, investors get all of the cash flow until they get a certain percentage each year. So essentially what that means is we're not splitting the profits until you get a certain percentage of cash flow each year, meaning you get all of the cash flow until we get to that certain, cash or ROI amount. So what's the benefit of that? Well, it says that we have to be we have to succeed in order to get a piece of that cash flow. So we have to do better than the preferred return before we as a general partner get a split of that cash flow. You'll see the preferred returns from 6 to 10%, and some people might not have it at all, right? Because it can be a little bit confusing to people, and other people might just want to split every dollar 50-50 or 70-30, right? So it's normally better for you as an investor to have a preferred return, because it just shows that the operator, manager, ourselves, is very confident that the deal is going to do well. Next up, when it comes to preferred return, a very important word in the PPM is going to be cumulative or non-cumulative preferred return. So essentially, let's say you buy an asset and you know what, year one, we had to spend a lot of money renovating it and raising rents, and we didn't get any cash flow. So what happens to that preferred return? Let's say you've got a 6% preferred return year one, right? You're supposed to get that 6% of that first cash flow amount. And essentially there was none to distribute. So now it's year two. And let's say there is cash flow in year two. Well, if it's cumulative, which is better for you, you want cumulative, that means the payment, you got to get reimbursed for all of year one. So you got to get your 6% for year one. So let's say you invest $100,000. You need to get $6,000 in cash flow to fill you up for year one, and then $6,000 in cash flow to fill you up for year two before we as the managers start getting a piece of that cash flow, right? Pretty great. Then next up is the equity split. How do we split the cash flow after this preferred return? And everyone's going to be different. You'll see 50-50, 90-10, 70-30. The way you kind of look at those equity splits is essentially, well, how good of a deal is it? Number one, if someone bought the deal and it's a new construction deal, A class, the numbers are super thin, they bought it on the market, they had to, bid against a bunch of other people, you're probably going to get something like a 80-20 or a 70-30 type of split. Meaning for every dollar after the preferred return is met. So let's say, as an example, you invest $100,000, you have a 6% preferred return, you get $6,000 year one of cash flow, but now there's one more dollar left over. How are we going to split that dollar? And essentially it's that ratio. Is it 80-20? So 80% goes to you, 20% to me. Is it 50-50? Half goes to you, half goes to me. And so essentially that percentage is what's baked into the underwriting of the deal to make sure that, you can get a good return. We can model it out to make sure that you get a good return. So if the sponsor buys a really great deal, they buy it off market, it's expected to have a really great, return on investment. You might see a equity split of like 50-50. If you buy something that is, new construction, slim margins on the market, you might see 80-20, even 90-10, right? So that's kind of the difference between the ratios that you see. So the big one is that it doesn't mean one's a better deal for you. If you see 90-10, so you get 90% of the profit and the sponsor only gets 10, that doesn't mean that that's a better investment than, let's say, a 50-50. It just means that the margins are tighter, which could also be riskier. So each thing's got its own pros and cons. More than happy, to dive into that. So you've got your cash flow, right? That's pretty simple. That's ongoing as time moves forward. But next up, what about the cash distributions from a capital transaction? So a capital transaction means that you're going to do either a cash out refinance or sell the individual asset. So from a cash out refinance standpoint, think of it like the value add strategy or a BRRRR, essentially. You buy the property, renovate the property, so increase the value, refinance at that new higher amount. And then once you've done that, hopefully you can give some of your original investment back, right? And have none of your own money in the deal, right? That would be the dream. And this is basically breaking down how you would get paid for that refinance, and then also the sale of the asset. For these individual syndications, most of them have an end date, meaning we want to sell the asset at year 5, 7, 10, something along those lines. So how are we going to give that money back when we refinance or sell the asset? And number one is you have to receive 100% of your initial capital contribution back. So you invest $100,000, you need to get your original investment back. So number one, boom, we give you your 100 grand back. Then number two is until you received all of your preferred returns. And if it's cumulative, that means you got to go back retroactively and get you that, let's say it's 6%, 6% year 1, 6% year 2, 6% year 3, and make sure you got that 6% every single year. And then once you've hit that 6% amount, then everything will get split based off of the equity split that we talked about before, whether that's 50-50, 70-30, 80-20, right, as specific examples. And the good part about this is that for a lot of these syndications, once again, they're all different, but for ours, there is no cap on the upside, right? You have essentially unlimited upside potential. So if the deal just crushes it and we do extremely well, cap rates compress, rents go up, right? Interest rates go down, right? We're selling these assets in year 5 or year 10. So it can be a different economic environment than what we're in today, which is really exciting. And let's say you smash the deal and essentially we're just going to split that profit in this example 50-50 all the way until until we've given back all of the cash that is available in the form of a net profit. So next up, it's a lot of work, right, for us as the manager, as the general partner. And so if we're going to charge fees, just like you would see from a property manager or you'd see from a lender, right? They get fees for doing the work and the compensation. And the number one fee, or these are just some of the common fees that you'll see to just be familiar with. One of them is the acquisitions fee. So this is the compensation for the manager's efforts in conducting due diligence on the property and making this investment opportunity available to investors. So essentially, you don't just buy a deal, the first deal that you see, right? We have to go travel to properties, sometimes different markets, right? We have to spend money on all of that. We are spending our time analyzing countless deals, spending countless hours, huddling up, making offers, doing our due diligence, spending money on due diligence as well. And for deals to either just not pan out, and essentially because of all that, that's why we have the acquisitions fee to get us reimbursed. Then next up is the asset management fee, which is the compensation for the manager's efforts for oversight and management of the company. Essentially, once you always have a property management company in place, but with an asset of this size, right, you have to manage the managers. Might sound a little weird if you're not familiar with this space, right? If you're in the single family home space and you only have one asset, right? The property management company can really be on autopilot. But when you're talking with a $10 million apartment building, right, you need to make sure that you are poking, prodding, asking questions, reviewing the financials, and really diving into the individual asset and going above and beyond, because the more involved you are and the more intertwined and in sync with the property manager, then the better chance you get a good return on investment. And essentially, we're splitting the profits. So we're all in this together. And that's one of the fun parts. And then we also have capital transaction fees, which is the compensation for the manager's efforts in marketing the property for sale or refinance. So just what we talked about before, if we're going to refinance the asset, we just refinanced 3 assets, and it was a full-time job for one of our partners, Brad Reedy. Shout out to Brad. And it took him months. I'm talking every single day. Lenders asking questions and needing information. If you've ever done a refinance on a multi-million-dollar property, well, you understand the amount of time it takes. And that's just to reimburse us for that time. Same thing with the sale of an asset. Brokers, buyers, all going to be asking questions, needing information, poking and prodding, and that just takes time, right? And that's what the capital fees, transaction fees are for. Next up, the good part about all of this is, as the manager, we have a fiduciary duty. So we are acting as a fiduciary, which is very, very important. So we use our best efforts when acting on the member's behalf. As a fiduciary, we do not act in any manner adverse or contrary to the member's interests. As a fiduciary, we don't act on its own behalf in relation to its own interests. And as a fiduciary, we exercise all the skill, care, and due diligence at its disposal. So we put your interests ahead of our own, and that is a very special relationship, and one of the many reasons why these syndications are so popular. Now, with all that said, while yes, we're acting as a fiduciary, yes, we're splitting the profits, yes, we want this deal to exceed, because then that allows us to go and grow and do more deals. There's a lot of risks, okay? And the PPM is going to dive into all those risk factors. We got a bunch of them on the left-hand side. Essentially, we'll let you read all of those and just fire through. But essentially, you could lose your investment, right? There's risk of lack of diversification. We're only buying one per apartment building, right? We're not buying 100. The due diligence, we may have missed something. Essentially, the success of the company depends on the manager's ability. What if you go with a manager that's never done this before? Well, that's risky, right? Versus someone that has done this and owns thousands of units. Lack of control and limited voting rights for Class A and B members. So if you're a member, right, you don't have a lot of control, just like what I said before. So that's also a pro, because it means you have limited time in the investment. And you're admitting, hey, I'm not a real estate expert and I don't have any time, right? But that also means that you have to trust the people that you're partnering with, because they're the ones that have control of the company. Then limited transferability or liquidity of the interests. It's not a stock. You can't just click a button and sell it. While sometimes you can sell your individual interests, it takes longer. It's a little more complicated. But these are long-term investments. You need to be investing your retirement money. When you have those 3 buckets of money, you have your now, later, and never buckets. This is your never bucket. This is your generational wealth. I want to pass this on. And that is why you can invest in your retirement accounts, which is nice to know as well. So a lot of things that could go wrong, right? So, hey, well, why would you want to even invest in something like this when all these things could go wrong? It's like, well, if you find the right team, the right asset, the right market, and just put this all together properly, you can really get a great return on investment. And that's exactly what Sean Taggy is going to dive into next. He's going to go into one of our previous deals that we have actually done, so you can actually see what the numbers look like, what does a deal look like, and what is the actual return that we've been able to achieve, and something that we're extremely proud of. So thank you guys, for listening. Hopefully you found some really great value. If you want any recommendations for books or knowledge on where to go to learn more about apartment syndication and being an investor, please let us know. And this is something that we are very, very passionate about, and something that we would love to be able to talk more about in the future one-on-one. So off to you, Sean. Thank you guys very much.
Hey guys, Sean Taggy here. We are chiming in for our third and final day of the SOFA Summit. Thank you so much, everyone, for participating, for giving comments to us, asking questions, all the great reviews and fans that we've had. We're so grateful for all of our clients that have bought a turnkey property from us or invested with us in some way, and for being here. Today, obviously, on the SOFA Summit is multifamily investing. So trading in those greenhouses for a red hotel or a big, large multifamily. And that's what I'm going to be going over today, some case studies of some multifamilies that we've done. So let me share my screen here and present. Yeah, so here's what's awesome is that we have done about collectively the partnership. Well, Jim Reedy, our senior partner here, he's done tens of thousands of apartment buildings over his career. He currently owns probably over 1,000 different apartment buildings. And of that, 650 about the Memphis Investment Property Partners have syndicated, meaning we brought in other investors to join in with us. And then the others they just own personally, the different partners of MIP. In case you don't know me, I'm Sean Taggy, the partner and chief operating officer of Memphis Investment Properties. And so yeah, I'll be going over two in particular multifamily apartment buildings that we bought and have owned for just over 2 years and just barely refinanced. So let's dive on in. Before my lawyer makes us state this disclaimer, all financial information is deemed reliable but not guaranteed. Performance and projections are estimated and subject to change. The provider shall be held harmless if returns are not met. All investments have risks, and investors are urged to perform their own due diligence and seek professional assistance. Actual results may vary, right? This is real estate. This is life. This is not a solicitation to buy or sell any private placement memorandums or securities with us. It's just for educational purposes. These views and opinions are for informational, educational purposes only. So now that we have that out of the way, let's go into one of our first multifamily apartment complexes that we syndicated with other investors. So this one was purchased May of 2020 for $3.4 million, and it was 124 units. So very low purchase price if you look at that. And the reason being is that this property was very dilapidated, very needed a lot of repairs, and very low occupancy. So 56% occupied. Those in the multifamily space would be like, this is a heavy lift. This is a lot of work. A lot of people just don't even go for this because it's just too much risk for them, especially if you're out of state investing. I don't know if you could take this on. So it really worked just for us because we're local. We have boots on the ground and lots of experience with really rough properties like this. We tested this whole strategy on several other apartments before with our own money, made our own mistakes with our own money, right? And then brought it on with investors. So we felt confident we could do this because we've actually proven it, had other apartment complexes nearby and lots of single family rentals that we could take on. And even at 56% occupied, it wasn't even fully collecting, only 80%. And so we got a loan. It's called a bridge loan. A bridge loan is like a short-term 1 or 2 year, maybe 3-year loan. It's not like a long-term 30-year fixed loan. It's just a short-term loan from a local bank here. It's at a higher interest rate, like 6% or so. I mean, still pretty decent, 5 or 6%. Short-term, as I mentioned, and it was amortized over 25 years, but then had a 2 or 3 year balloon, meaning the whole loan was due in that time. But of course, you could refinance before then. They had some extensions and everything like that. And so yeah, we raised $2 million of equity, but we used debt for the rest of it for the purchase and reno. And market rents were very low because the units weren't in great shape. So at $550 a door was what they were at that time. And we knew that we could come in and fix it up. So here's one of the units. Now, this isn't what this one wasn't an occupied unit, but basically the owners were just kind of just letting it go down. Is they weren't reinvesting equity back into the deal. They're kind of just trying to juice it for everything. Like, for example, 2 of the units had a fire in it. So, they had a small fire and they burned down. They just took the insurance money and didn't re-renovate the units and get them back online. So a lot of the units were like this, just kind of sitting there, not even being rentable. And then the ones that were rented were very outdated. So yeah, like the roofs and shingles, a lot of the exterior needed work.
There was erosion problems. The sidewalks weren't in great shape. Lots of the rails around weren't good and fallen down and safety hazard. The roofs, all of them needed replacing basically. A lot of the ACs, some trees, the fences around the property. So I mean, pretty much everything needed a lot of work. So these are some before pictures. Just needing some work and jobs kind of just half finished and other things like that. So here was our strategy, right? We're going into this. We're well aware of what's going on. We did a full due diligence, made a full reno budget on it, and here's the plan. We already realized that the management on site was not working well, so we fired the current property management company and brought on our own, right? So we had kind of control over everything. We had control over the property management owned by Reedy and Company, Jim Reedy, the partner of MIP, his sister company. And so we brought on a new on-site property manager, and that person has already worked in this area, already knows how to deal with this type of area and tenant base, and very experienced in it. So this new property manager, she became the sheriff in town and really watching everything and changing it from the Wild West to, kind of the new century age, right? Of just policing the area. And so that was one of the keys, is that we are local. Not only we manage the property management side, so alignment of interest there, very very much so. Then also on the renovation side, we used our renovation company, Value Home Maintenance, to renovate all of this. So just basically we controlled all pieces to the puzzle. Hence we felt very confident in it. And so, you just kind of go in day one, and it's kind of crazy for the first few months, but you just see who starts paying rent, and whoever pays rent, well, they're on the nice list, right? Like Santa, right? And then the ones who don't, they're on the naughty list. And we stick to the same process. We don't treat anyone special or not. It's just rent's due on the 1st. You have a grace period till the 5th. On the 6th, it's late, 10% late fee. And then we start calling you, knocking on your door every other day or several times a week, and try to get you to communicate with us. Let us know where you're at on paying. And then if you don't pay by the 15th, then we file for an eviction on the 16th. And so that's it. Then because the landlord-friendly landlord-tenant laws, as you've kind of heard, we can get them out in a couple months after that. And so, yeah. And then also, of course, if any of the tenants are paying but breaking the law, or not being courteous, or anything to the code of conduct, we obviously get them out as well. So that's kind of what we do, and just start returning all the tenant base. And so we kept a lot of the tenants, but a lot went out as well. So then a big thing too is just kind of, there's a stigma, right? People go and then they move out because it's too dangerous or too rough of a place. So you just kind of had to rebrand the entire community. So we took out the old name, put in a new name on this apartment complex, and just started creating a new community culture. One of the big things is we put no trash signs, don't throw trash. And the manager looks, they find people, and if they throw trash out and put it on the side or by their car, they'll fine them. And so the manager's walking the property every day, picking up as much trash as they see. And just that alone starts turning it around, right? And we put in nice dumpsters and actually empty the dumpsters, frequently. So because by the dumpsters, it'll get full and people just toss all their trash around it. So that creates an issue. So we make sure to have those emptied. I mean, just basic, kind, courteous, logical things. I mean, this all sounds like that. It sounds like rocket science, but it's not. But it's surprising how many people just don't do these basics. Another thing is that as new tenants come in, we're actually, answering their phone calls or greeting them when they come into the new management office and touring them with the unit. So just the basics of good customer service for new tenants coming in, and letting them know the ground rules up front. Like, hey, we don't play around. Here's how rent's collected. Here's the process. Here's the rules. Here's the code of conduct. Just all that. It's just communication and all that. So then, of course, we do extensive renovations, and we start the exterior because, number one, you don't have to get inside. There's no tenants you're disturbing. And also it just kind of paints a whole new picture for all the tenants that we're here to stay. We're not playing around. It's going to look amazing, just like the outside and the inside. So we did a lot of exterior work, and we'll show you some pictures on that. And then we renovate the inside units, especially the vacant ones first, of course, as there's a bunch of vacants, so it's easy there. We renovate 5 to 15 at a time. Economies of scale. A crew can go in and cut, you know, the same board or the same piping. They're all pretty much the same floor plan. So he just, once when he does 1 or 2 floor plans, he knows exactly, he almost memorizes the measurements on everything and the materials needed. So they can just roll on through. So they do it a lot quicker and for a lot more cheaper economies of scale. But also you don't want to renovate like all half the units right then, because then a bunch are, you spent all this money and you're paying interest on that money. Because as we draw against the renovation loan, you have to pay interest on it. And it's just kind of held in reserve and use it and you pay for it. So you don't want to renovate too much and be too far ahead of yourself. So we kind of have a cadence and a pace that you work with the property manager on for figuring that out. And then as the tenants occupy, then you renovate some more. And obviously from there, we can raise the rents. We started raising the rents. We targeted at $695, $750. But as the market started growing and the place started gaining popularity and demand, supply and demand, we actually getting rents up to $895, $950. So we were able to increase rents $300 a door plus. And we just kind of watched the market as that went on and the supply and demand that came in. And obviously screen and place great new tenants into the community, right? We want to create a great culture and vibe. Just, I mean, you know, just good paying people that stick to the rules, right? And we will do our part as well. We will fix the property, keep it good, clean, and safe. You pay your rent and treat others well and don't trash the place, right? It's pretty easy, but harder said than done. So here's kind of the reno as it's going on. We did a lot, all the roofs as mentioned, and the siding. We started painting the bricks. Obviously, there's a toilet out there. We replaced a lot of the toilets, a lot of plumbing issues, electrical, just the whole shebang. And cosmetic on the interior, new kitchens, cabinets, countertops. Big things that helped out with this reno and increasing the rents was putting washer and dryer units in here. Before there weren't. So it was really hard. People would have to go. You know, it's inconvenient to have to go to a laundromat or an on-site laundromat even. So this made it a lot easier for the tenants by having washer and dryer units. I mean, this is awesome. Just the crews just rolling down several units at a time, getting this exterior siding that lasts longer and looks better, rolling in. A lot of the sidewalks. So all this reno, kudos to Jim Reedy, Valley Home Maintenance, his team. We've talking with Jim Reedy, my partner, senior partner. He has renovated over 7,000 doors, 7,000 doors over his 40 years plus here working in Memphis. So I would say that's probably more, I would dare say, than anyone in Memphis, Tennessee, at least, of renovations. So we've been around the block. Anyways, it's an amazing job. So anyways, yeah, lots of sidewalk work, landscaping. As you can see, it's kind of fun to see this heavy equipment in here. This is awesome, impressive work here. A lot of erosion happened here, so I had to fix some of the units and put little fences around them in the entrances, just so it's a little more private for the tenants. So here's kind of the story. I graphed all this out. So we had a goal, right? In blue is our occupancy goal. So obviously from just above 50%. And then in 2 years, we want to be above 95%, 96%. That's when it's really stabilized as 90% plus occupied. The red represents actual occupancy. So as you can see, we obviously, in the first 3 months, we actually found out of the 50 whatever percent tenants that were in there, some of them weren't paying. So we had to get rid of them as too. So it had dropped near 50% and then started climbing back up as we started gaining some ground and kept the tenants in there, and then just really started getting stabilized towards a year and a half in. I mean, we're in the 90%, which is in the green zone for a refinance and calling it stabilized, where you can get some nice long-term Fannie Freddie debt. So just really awesome. Smashed our goal on this. Of course, like, it does have a factor to do with how good we are at screening and getting tenants in and customer service. But a lot of this also, is the mercy of the market. The market was really good at this time. A lot of supply and demand in Memphis. Memphis was one of the top Google searches for properties for rent in the country. So it did amazing. But obviously, a lot of that has to do with macroeconomics and us zoning in. So here's some after photos. So obviously we painted the brick, nice screen doors. So these screen heavy duty security doors, put it on every unit. That's nice for just the tenants' feeling of safe and everything like that. The nice siding, some landscaping, just, hey, not a piece of trash on the property, right? There's just everything like that. It looks amazing. Fixed some parts of the fence that were broken boards and lots of whole sections as well. Here's the interior. So yet again, I mean, these are 2-bedroom, 1 baths, 800 square feet. So these aren't huge, luxurious mansions, but they're nice, clean, and safe. So we had, washer and dryer right there, stackables, which was nice in the kitchen. And then, just your basic appliances and cabinets and countertops. Here's kind of the living room area, new blinds, obviously paint, new LVP floors, just all the basics, this was the model unit, kind of making it feel homey that would show to the tenants. So, just a nice, clean place to live. All right, to the numbers, which is, what I like is the numbers part. So after basically about 2 years of owning this property, we were able to refinance. Okay, got it up to 96% plus occupied, high collection rate. So the average market rents are $850, and really we're pushing $950, $900 in a lot of the units, like currently as of today's rent. So, but a $300 a unit rent increase, which is massive. Most people increase the rents $100 a unit. Now that's because there's not much room to grow. We obviously had a highly distressed asset. So this puppy, as you remember, we bought it for $3 million. It appraised for $11.1 million. Now, obviously, we put a lot of renovations into it. We had an initial investment of $2 million, as mentioned, of equity. The rest was debt. And so we were able to pull out $1.6 million of our initial investment, or 80.8% of our initial investment back out. So we still own it, all our same percentage, but now we only have 20% of the money that we put in originally in it. Okay, so owning a $11 million asset for $400,000 down, basically. So that's very low down, I believe, like 4%-ish. So yeah, 4% down. Now, obviously, you had to put more in at the very beginning and keep it in, but now you've pulled it out. So lots of. So this is the awesome part of multifamily and real estate. I've already explained cash out refinance is that you can take your chips off the table. You yes, you put the 20% down, but this one's quick because it's 2 years, but 5 years, 10 years, you definitely can pull almost all your money. I think definitely in 10 years, depending on the market. So that's amazing. Just blows my mind. You can own it for that little down. And I've seen lots of case studies too, where you can have even more pulled out than what you put in. So now what's awesome is that money, that 1.6 million, came back to all the investors, pro rata, proportionally to how much they put in, 100 grand or 500 grand or $1 million, right? They got their proportional 80% of it back. And so now that 80%, you can go do whatever you want. You can go invest it again in another deal, put it in the stock market, lend hard money, or put it for savings. So it's kind of just shows that it can grow exponentially, and do another deal, and 2 years later pull out that money and go from there. So this is a little complex. Bear with me, go a little slow. I'll go slowly here with you to kind of explain this. It really, though, paints the picture and helps you just see kind of the value in our projections. So obviously year 1 and 2 are actually actual numbers, and then projected from years 5 to 7. We plan on selling it in 5 years, but who knows, depending on market conditions. So obviously year 1, we put in 2 million of beginning member capital account, 2 million of equity. So 100% was invested. And we didn't have money for the first 2 years because we're putting a lot of the money, reinvesting all of it back into the renovations. So no cash on cash return for the first year. So there's pros and cons to this strategy. You're no money for a while, but wait till year 3 and you'll see how awesome it gets. And so nothing going on. So at the very end of year 2, though, you got 80% of your money back. So there's only 384 left in. So now here's where it gets awesome. For this year, we're projecting, and this is, pretty conservative numbers here, but getting 122,000 of cash flow, or of your money left in. So this cash on cash return is your, the cash flow divided by the capital account balance. So 30% cash on cash ROI. I think that makes up for the first 2 years of nothing. And actually it does. So average cash on cash return is, how much cash in total, in perpetuity we've made divided by the investment. So 10% is our average cash on cash return. All right. So it almost makes up for it at that year. Then every year, we plan on a little bit more cash flow coming in. This is because we're catching up of a preferred return. Then year 6 and 7, that drops down. But yeah, anyways, a 30 to 35 to 28% cash on cash. On average, the cash on cash return is 23%. amazing. I would freak out, be jumping for joy at, 4%, right? So multifamily is pretty awesome. And that's just cash on cash. There's the investors also got a lot of tax benefits from this tax write-off. So you're not paying taxes on those. And if you're a full-time real estate investor, as Chris Pucuros mentioned, the accountant from Day, I believe, too, that it gets even better. So average annual return to date, there's that, pretty similar, except for this gets bigger. Why does this get bigger? Because there's net proceeds. So this is cash on cash only. This isn't factoring in equity. So when we sell in year 7, so in 5 years from now, we will be able to get back $2.9 million in proceeds. This is us projecting they're selling at 110 a door, which is only they appraised at 90,000 a door. So it's only a 4.4% appreciation for 5 years on average appreciation, which I think is conservative, but we'll just leave it there. So $2.98 million pulled out year 7, which therefore bumps up the year 7 return because you have your cash on cash return of 108 plus 2.9 million. So 3 million, which is right here, total return on investment for that year. Okay, so an amazing return that last year, and that's real estate. You make a lot of the money from principal pay down and appreciation when you sell, right? And so total returns, so 644,000 in total cash flow. That's the sum of all this, 2.98 million in appreciation and mortgage pay down, et cetera, et cetera. And obviously the return of all the member capital, because you get your capital back. So all of your money's returned back as well for the rest that's left in. So total return of $3.5 million on 2 million. And then so a return of 178%. And if you average that out, it's a 24.5% average annual return and IRR because you refinanced. So yeah, amazing. Excuse me. So there's that. Those are all projections, but feel pretty confident, feel like it's pretty conservative. All right, and on to case study number 2. So we purchased this October of 2020 for 2.9 million. And it was same story. I'm not going to go through the whole model and everything. We did basically the same exact thing, very similar, very within the same realm of each other in the southwestern, southeastern part of Memphis by FedEx. The occupancy was 50%, and we put an initial investment of equity of $2.5 million. So here was the stabilization. It obviously dropped a little bit as well because we had to get rid of some of the inherited tenants, right? I don't even know, the stepchildren we inherited, whatever you want to call it, and then it started going up and we started raising rents and everything like that. Got up to about within a year, up to 90% occupied. And so we're still rolling from there. And so here was so once we refinanced in 2022, just recently, it appraised for 10.8 million. We got a 65% loan to value loan. Cash out, so $7.049 million loan out. Let me explain the loan. So both these loans were the exact same as the first one, the 124 unit and this 128 unit. It was a 4.69% APR interest rate. Okay, that was just barely locked in. So I mean, rates are still pretty good for multifamily, is based off the 10-year treasury and some basis points above that. It was a 10-year term. So that means in 10 years, the loan balloons. You have to pay it all off or refinance. Obviously, you just refinance. That's the traditional way of going for it, or sell it. It was though 30-year amortized. So the loan is amortized over 30 years. So, and then what was also awesome, it helps our cash flows of 5 years of interest only. So, and that's why we want to sell in 5 years, is because then it starts paying principal payments and it lowers your cash flow. So that just helps the cash flow for the first 5 years be way amazing, like mentioned, 30%. And so we were able to cash out 2.1 million of equity, and we left in then around almost 400, little under 400,000. So 84.4% of your equity cashed out. Yet again, amazing. Jumping for joy. I invested in all these deals. We all invest, and all the partners invest our own money. A significant portion of that 2.5 million raised is our money, right? So we're enjoying the fruits of our labors, and also we're in it through the thick and thin. Either way, it's a significant portion of our wealth, and everything is in all of these deals. So it matters. We're here with you. We're not gonna do this, just with all investor equity. I'm going to show some skin in the game. All right, so this now shows the returns. I'm not going to go in quite as much detail as before, but yet again, the first 2 years, no income because we're heavily renovating it. Pull out our money, so only 400,000 is left in. We get 142,000 as our projected cash flow, so a 36% cash on cash return on investment of the money left in, 12% average annual return, and then it gets up to 27% average annual return. Total cash flow of 748,000. We're going to sell it yet again 110 a door-ish. So 3.2 million pulled out, 147% average annual return to date. And then 160% total return on investment, 4 million total equity in return of money. All of your money's returned, and a 23.68% average annual return, or IRR. So amazing. I think it's somewhat conservative. Yet again, only a 4.5% appreciation, 4.4% appreciation estimated. And yeah, pretty exciting. So thank you guys so much. I appreciate you listening in, checking us out. Please make sure to subscribe to our YouTube channel. Please support us by, subscribing, which supports us, commenting, watching us, but also telling your friends about this, about what we can offer, buying some of our turnkey properties or investing with us. And we're so grateful for everything that you do. Thank you so much. Have a good one.
Hey everyone, welcome to the next session for the 2022 SOFA Summit. Really excited to introduce one of our current clients here at Memphis Investment Properties and Reading Company, someone that we've been working with for many years now. His name is Blake Brumley. Blake, how you doing this morning?
Doing great, Mark. How about yourself?
I'm doing well. I really appreciate you taking the time to share your experiences, with everyone here at the SOFA Summit.
Sure. Thanks for having me.
Yeah. So let's just get started here. Why don't you just tell us a little bit about your story and your background?
Sure. Yeah. So I'm originally from upstate New York, Rochester. Go Bills. Went to University of Buffalo and have since then moved to the New York City area. So I've been down here for about 11 years or so. Met my wife, my now wife, immediately after moving to Manhattan. And now we've just kind of slowly drifted out to the New Jersey suburbs. So we're about a half hour outside New York City. We have a 4 and a 2-year-old. My full-time career, I sell medical devices. So I sell GI endoscopy devices. So we treat and diagnose different cancers and diseases of the gastrointestinal tract. So it's a nice, rewarding job. So I've been doing medical device sales for about 15 years now. And then in my limited free time with the kids, we like to travel. They're at an age where we can travel a little bit easier now. They just did a nice long car ride, so that opens up the world of possibilities. And I also do Brazilian Jiu-Jitsu, and just recently started teaching as well, Brazilian Jiu-Jitsu 1 day a week, and have started to bring my son, my 4-year-old son, so that's been a fun time.
Yeah, that's great. Sounds like you're a very busy man. I love it. I love it. So why did you decide to invest in real estate in the beginning?
Always wanted a way to build wealth outside of my career. Watched my parents work really hard growing up, but never really had anything to show for it. And they'll be the first ones to admit that. So I wanted to find a way to kind of supplement my income and build wealth and generational wealth for my family. And driving around so much for my job, it was easy to listen to podcasts and YouTube videos and kind of educate myself. Zig Ziglar talks about automobile university, he called it. back in the day with the CDs driving around or tapes. And nowadays we could just plug in a podcast. So I listen to a lot of bigger pockets, which is how I found you guys originally. And just kind of listening to a lot of different real estate stories and different podcasts and YouTube channels and audiobooks that kind of really helped to educate myself a couple years prior to jumping in real estate. Always been obsessed with the early retirement. So would love to retire early at some point using real estate, or at least have that option to do what we want as a family when we want, not be relying on this W-2 income. It was an easy sell to my wife. My wife's grandparents did real estate, and Mark, you were really helpful in that in our first couple initial calls, just kind of talking about the Memphis market and what you guys do. But my wife's grandparents had done real estate for years, so it was a little bit easier sell for her.
Yeah, I appreciate you sharing that. I mean, you hit a lot of good points there. You know, number one, when it comes to real estate, education is key, since it is this alternative asset class. And that's the whole reason why we do the SOFA Summit here. And I completely agree. I remember when Zig Ziglar said it was the automobile university, and it's a great way, you know, to utilize your time, right? As opposed to just listening to music, you can actually learn a skill. And then that skill can create, like you said, the generational wealth, something that you can actually pass down, right? It's an asset that you can give to your children. And then also to be able to create more of that financial independence so you can retire early and spend more time with your children. Ultimately, that's just one of the exciting, you know, fun parts of real estate as a whole.
Absolutely. It kind of helps me sleep better at night knowing that we have hard assets as well with real estate. It's a tangible thing. It's not a 401k sitting there in the metaverse or wherever it is. It's tangible, and we can touch and feel it if we want to.
Yeah, definitely. And so speaking of the tangible assets, you know, they're located here in the Memphis market. What do you like about Memphis from a real estate perspective?
I think the biggest thing for me is the moderate weather. So knowing that we don't have to worry about coming from Western New York. I had a lot of big snowstorms. When we first thought about real estate, I thought it might make sense to go back to Rochester, where I'm from. It's kind of a similar median price to Memphis, but the biggest deterrent was the harsh winters and not having a team there. So Memphis, with the moderate weather, you don't have to worry about tropical storms and hurricanes and tornadoes coming through. That's a big thing for me. Again, helps me sleep better at night. I like the low cost of entry. So living outside New York City, it just doesn't make sense to invest in real estate around here. So the price points for the Memphis market is definitely a benefit for us. And I like that it's a predictable, steady real estate market. I know you've had some great appreciation over the last couple of years, which is a nice plus, but just historically, that nice, steady trend of increasing. I also love the fact that there's good, stable jobs in Memphis for good, hardworking people. With I think it's the second largest cargo airport in the world next to Hong Kong.
Yeah, we actually
is that still accurate?
we just surpassed, and now we're number one, which is
Nice.
exciting. So, but yeah, you're exactly correct.
All right. And then FedEx and Amazon and St. Jude's, I know, just recently built a larger campus. So good news is lots of jobs. Don't like that a lot of sick children are filling that hospital. I wish it was slow, but it's good to know that there's a lot of good steady jobs. And one thing that I've learned to like about the Memphis market is the tenants bringing their own appliances. So I didn't realize that when we bought our first property with you guys, and that was just an added bonus of one less thing to worry about.
Yeah, really good points. I mean, when you know, here we will provide the dishwasher and the Vena hood, and that's in our B and C class areas, and the tenants bring everything else, which is it blew my mind when I originally moved here from Colorado. I thought something had to be wrong. It's like,
Hmm.
why would anyone want to rent that property? Is a question I always asked. And it's the market, it's the norm. And then when you think about it, you say, okay, we could still rent properties. And then when if that tenant brings their own fridge and that fridge breaks, well, they're not calling the management company, right? And they're gonna fix it themselves. So it's all about reducing expenses, and that's just one less thing you have to worry about,
Absolutely.
which is very well said. So then, we've been working for a couple of years now. How's your experience been with MIP and Reedy and Company Property Management?
It's been great. It's nothing but positive. Mark, you took the time with us from the very beginning. I believe we bought our first property with you in May of 2020. So kind of right in the heart of COVID, which seemed a little crazy at the time, but you kind of you made us feel a lot more comfortable, and led me to some good research and let us pull the trigger. So you've been reliable and trustworthy, and the whole team that everyone we've talked to at Reading Company and MIP, it's been phenomenal. What I like the most is that I can trust the team being hundreds of miles away. I've never stepped foot in Memphis. So knowing that you guys are the boots on the ground and can get a question answered and fix something if something goes wrong right away. I love that. Um, so what I really like about Reading Company too is they have it down to a science. So, and you guys are always working on ways to improve the processes. So just having everything stored in your warehouse ready to go for the next rehab, so you don't have to wait on supplies. And with the supply chain issues that are going on, it's nice to know that everything's taken care of. And correct me if I'm wrong, I believe the Reedy team that does the rehab are also the people that manage the property, so they get the calls if something goes wrong.
Yeah,
That's correct.
that's exactly correct. We just keep that in-house there. So the same people that are renovating the houses on the front end are also the same people that would help do the maintenance and the turnovers, on the back end. And that's all in-house as well, which just keeps things efficient at the end of the day.
Yeah, yeah, I love that. Yeah, I would love to meet you guys at some point. Get to Memphis, get some barbecue, and a couple other things I love is Jennifer sends the bullet points of all the next steps. So once we reserve a property, it keeps me nice and organized. I'm not very smart and a little disorganized, so it's nice to have that all bullet point. And a really important thing for us is that the Reedy has a good reputation with the tenants. So they've done it for years. I think you have over 2,000 properties that you manage with Reedy, if I'm correct.
Yeah, on the
Um,
single family side, that's exactly correct.
yeah, and I know there's a long waiting list of people trying to get into Reedy properties. So they take care of the tenant, which is really important. I never want to become a quote unquote slumlord, especially being far away. So it's nice to know that the tenants are being taken care of.
Yeah, 100%. I mean, at the end of the day, that's the tenants are the most important part, right? Because if you have happy tenants, well, then they'll take care of the property, they'll stay, they'll pay rent on time, and then that equals, great cash flow, for you as the actual investor. So just all we do is listen to the tenants, and sometimes the tenants get mad because we try to collect rent. So that's always funny when they get mad at us for doing our jobs, but it's also the ones, making sure that we can, respond to the maintenance calls, and making sure that it's also nice that we're here in person. So if they want to actually talk to a real human being, they can come into our office, which is always nice. But yeah, very well said. So why don't you talk a little bit about your portfolio? How many doors are you up to now? And, what are kind of the plans for the future?
Sure. Yeah, we're up to 3 properties, one B plus and a B minus and a C plus. So kind of diversified. I wanted to diversify a little bit on the class of neighborhoods and the cash flow, especially just as a base. COVID kind of woke me up a little bit that um, my income's based on GI procedures, GI endoscopy procedures, and those were those shrunk by 90% in March and April of COVID around here. So my income tanked. So I wanted a little bit of an extra cushion just in case. But as we move forward, we'd like to look a little bit more into the B plus and A minus type properties with you guys, and hopefully we can get one by the end of the year here. It's been really fun watching you guys grow. I remember a couple years ago, just kind of going back to the trust in you all. The properties would come out, and we'd have about 5 seconds to bid on one, and I would put it in and bid on it. If you get it, you get it. But just goes to show you just how trustworthy that I believe in all the properties and the team that you guys have. So yeah, look forward to building that portfolio. Hopefully maxing out our primary home is under my wife and I, so we get 9 properties, I think, under Fannie and Freddie. So hopefully trying to max that out and continue to grow the portfolio.
Yeah, well, I appreciate you sharing that, and yeah, during our original process was just first come first serve for the properties, and you click reserve, and whoever got it first is the one that got the house, and it just got so crazy at a certain point, people would reserve it in a couple of minutes and not get the house. So now we kind of took a step back and we do it the more traditional way that you'll see on the actual market of the MLS or the commercial market, where everyone gets to, place just their offer. And then essentially, we'll pick the best offer. And that's something that we were talking a little bit, about before, where you're thinking about doing a 1031 exchange, right, with a different property, and things that we can help out with, as well. Also doing a cash out refinance, things for one of the Memphis properties that you already bought, which is also really exciting. So some higher level advanced strategies, that we can help consult with, and more importantly, get you in contact with the best representatives to ask any questions about it, to make sure to see if it's a good fit for you, or not. So
Sure.
excited.
Yeah, it's been really fun to watch the real estate market in general, but especially in Memphis. Looking at the pro formas from the original property that we bought 2.5 years ago, and the estimated value is already over what the 10-year mark had said. I know you guys are nice and conservative with those pro formas, and it's nice to exceed those expectations.
Yeah, that's really incredible. So wrapping up here, for the new investor, do you have any advice for them, at the end of the day?
Yeah, I think the biggest thing is define your why. So, why do you want to invest in real estate? That was important for us, my wife and I, to sit down and figure that out. I think that really helps when you do hit some roadblocks along the way. There's bound to be some hiccups here and there in the long journey of real estate, especially if it's a buy and hold property. Um, if you hold it for many years, you're going to have some tenant turnover, a couple things that need to be fixed here and there. So just understanding your why and why you're investing in real estate makes those hiccups a lot easier to deal with. I would recommend to analyze, but don't overanalyze. So don't get stuck in the overanalyzation mode. So I was kind of lucky that we didn't have the funds to invest in real estate right away. So I was able to do some research and education myself for 2 years or so prior, and then once we got the funds, jump right in. But if you have the funds, take the time to research and talk to you guys. Mark, you were great from the very beginning, but take action and jump right in. I'd also recommend to network with other investors, to just bounce questions off each other, to help each other. That's always important. And then lastly, I would say to define your criteria. So your investing criteria. So figure out what you want to invest in. That might take some time. My strategy's changed a little bit over the couple years, but when you know your criteria, you can jump on an opportunity when it's available.
Yeah, I appreciate that. Well said. I mean, I really recommend, I like where you said at the beginning you didn't have the capital, but you were actually focusing on education for those first couple of years. And one thing that we really recommend is to say, even in that phase where put your mindset or the cap on is, if I had the funds today, which property would I move forward with and why or why not? And then that helps you build that criteria. So then when you do have the funds and the capital and you are ready to invest, you don't get stuck in that analysis paralysis, type phase. And that's also something that, we would love to be able to assist with as well in terms of, helping build that buy box or that criteria. Because there is, a little difference between the A's, the B's, the C's. I mean, there's also, that's just what we have here in Memphis. There's also D as in dog class neighborhoods. There's what we call dollar sign neighborhoods that are negative cash flow. Like there's other, neighborhoods and types of asset classes, but we can kind of go over all the pros and cons of all of them, at any time. But hey, I really appreciate you, Blake. We love the relationship. It's been, it's been wonderful to have been, working together, since COVID for these last couple of years. And it's already, it just means the world, that you're, happy and growing the portfolio, with us here. And at the end of the day, that's the goal. If you can just get a couple of properties every single year for the long term, it helps you hit your why and create that generational wealth like we always talk about.
Yeah, thanks so much, Mark. It's been fun. Watched the last couple Sofa Summits. It's fun to be on the other side of things, and I appreciate it, and I appreciate your partnership and the team that you all have.
Thank you. Thank you very much. Well, to everyone out there on the Sofa Summit, hope you found some words of wisdom from Blake, and hang tight. We'll be here for our next session here soon. Thanks, guys.
Hey guys, we want to pause a brief moment in between this session to say thank you yet again to our sponsor CLOSETRAK and Greg Ziskind, the main attorney over there. We're so grateful for them for helping us put on this event and sponsoring us and their partnership with us and the great work they do over there at their title company.
Definitely. So we've done hundreds of transactions with Greg and the CLOSETRAK team. They also have a individual point of contact for us and all of our clients. Her name is Amber White. She's an absolute rock star. And Greg he's a hustler. I mean, he's the kind of person that gives you that quick turnaround time over there at CLOSETRAK, but it's also extremely accurate, and they'll give us a group discount, so a little bit of cost savings as well. So that's what you, as the investor, as the buyer of the property, or potentially the seller years down the road, can leverage that discount. And that's the goal, how to save your expenses, increase that NOI. So thank you so much to Greg, Amber, the whole CLOSETRAK team. Y'all are rock stars, and thanks for sponsoring the day.
Yeah, back to the show. Thank you.
Hey everyone, welcome back to the next session for the Sofa Summit. I am really thrilled to introduce our upcoming speaker. This individual, he is an expert in the 1031 industry. His name is Scott Saunders at API Exchange. Scott, how you doing today?
Mark, I'm great. It's great to be with you for the Sofa Summit here. Thanks a bunch.
Yeah, we're glad to have you back. So Scott has done over 100, personally done over 100,000 1031s. He's actually at the forefront of the industry. He's the individual that actually lobbies for the benefits of 1031s to keep it around. He actually did. How many meetings did you do last
I
year?
had 66 meetings with senators and people in Congress last year, sitting down for about an hour at a time, just saying, here's the benefit of Section 1031. Here's why it's good for the economy. Here's what we do for the GDP. And here's why you don't want to mess with it at all. So we spent a lot of time doing that.
That's incredible. Because I remember last year, that was the fear, right? Oh, 1031, it's going to go away. If you want to do a 1031, you need to do it now. What are your
Right.
thoughts on that? I feel like they say that every year.
Last year that started, it was a proposal that President Biden had. So that's where it started, was from the president. And then that became a talking point, and it was a legitimate concern. I don't think it's quite every year, but what happens is it's really tempting to look at the amount of deferred taxes. And if you're in Congress and you want to scoop up extra revenue, they're like, wait a minute, we have all these fat cat rich real estate investors getting the benefit, and we could take that money and put it into whatever program better. What they miss is that if you take away 1031, the transactional activity with real estate would just come down dramatically. So it's not just the investor, banks, lenders, appraisers, the real estate professionals, anybody, people that fix up properties before you sell them, everybody would see less transactional activity. And so the number is staggering. It's a $96 billion a year positive for the GDP doing 1031s. It comes out of an Ernst & Young study. So when we show that data, all of a sudden they go, okay, we get it a little bit better.
Wow. Is there a statistic on the amount of transactions that are 1031 exchanges, like the percentage for the whole industry?
It's tricky. There's one for the commercial side that estimates about 20 to 25% of all commercial transactions are an exchange, either on the sale or purchase. Residential, we don't have quite as clear data, and it's tricky because you got single family rentals, then you got that hybrid, you got vacation homes where you
Yep.
can do an exchange in some cases you can't. So not really.
Yeah, but on the commercial side, that's a major portion for sure.
Absolutely. And the commercial brokers were, CCIM, some of those groups were up there lobbying with us for the same thing, going, hey, this would really hurt our industry. Particularly, think about it. We came out of that pandemic. We've got buildings that need to be reimagined and repurposed, right? There are hotels that aren't going to get as much demand. We've seen some of them converted over to condos. And it's a tool that helps people kind of reposition and repurpose real estate.
Yeah. So why don't we just dive in? What even is a 1031 exchange?
Yeah, 1031, when you hear that, it comes from a section of the tax code called Section 1031. What it allows is, as an investor, you hold any property for investment or you use it in your business, you can exchange it for what's called a like kind property that's also held for investment. So if you think of a sale, I take my property, I get back cash. When you do an exchange, you're just giving up property, but instead of getting back cash, you're getting back like kind property held for investment. So it's really pretty simple from that perspective.
Yeah. Yeah. And so from being simple, what are some of these rules and regulations, that you need to follow to actually do a 1031?
Yeah, the most common format is what we call a delayed exchange. So that's where you sell, you give up your property, and then you've got a certain period of time to purchase and identify like kind property. So in the delayed exchange, you sell your property and you close on it. That's day zero. You've got a 45-day window to identify a suitable replacement property, or people that are a little more savvy, maybe they identify multiple properties. So they've got a few options. So that's the first 45 days. That ends at midnight of the 45th day. Then you have another 135 days to actually close on what you've identified. So think of it as 180 days maximum to finish a delayed exchange. You close, you identify an asset or multiple assets, and then you do your loan, right? You do all the due diligence, and then you actually close on something that's been identified. So we call that a delayed exchange, is the most common format.
Sure. And so what we've seen a lot is that, you have that 45-day identification period, right? What do you have to actually do to identify during that time?
Yeah. To identify, you've actually got to zero in on specific properties. It's not as simple as saying, oh, I want to buy a 3-bedroom, 2-bath in Memphis. You got to zero down and get a specific property that you want to buy. I'm going to buy on this street, right? I'm going to buy on 312 Main Street. That's one of my identified properties. Fortunately, the rules, they give you a little flexibility. You've got two primary ways to do it. You can use what's called the 3 property rule. So I could identify 3 assets, You don't have to worry about the value at all, but you're limited to 3. There's another rule, which is called the 200% rule. So you can identify a bunch of smaller properties as long as you don't go over 200% of the value of what you sold. So let's say I'm in Los Angeles and I sell for $1.5 million. I could identify up to $3 million of properties in the Memphis market, which you and I know that's quite a few single family homes in that,
That's a ton.
B2C class.
Yeah.
So that's how you identify as one of those 2 rules. You've got to identify with what's known as a qualified intermediary, that party that puts the transaction together. And it's got to be signed and dated by the taxpayer or the investor by midnight of the 45th day. And that's the one, and I'm sure you hear that a lot too. Gosh, it's really hard in 45 days to scramble around and do that. That's set in stone. It's statutory. You can't get around it. But as you and I know, as working with investors, sometimes you can start looking a little bit earlier. You don't have to wait until you close on your sale. You can list your property and then start kicking the tires for what you want to purchase much earlier, right? Narrow the field of potential properties, get a good feel for the marketplace much earlier than before you close.
Definitely. Yeah. I mean, over here at MIP, I mean, we understand the stress of going through this process, right? You want to make sure that you can find quality properties and enough properties to actually be able to, not have to pay, taxes to Uncle Sam, because of course that's the goal. So that's why, we always make it as easy as humanly possible for you as an investor. So we do have a 1031 program. Whenever you are interested in doing a 1031, please reach out to, myself, contact us, let us know what your goals are, what your exchange amounts are. And, we will make sure that we can basically almost guarantee that we get you the properties. If you commit to the amount of capital that you're going to bring to us, well, then we can commit the houses and just kind of have that symbiotic relationship to, at the end of the day, just, reduce stress for everyone.
Yeah. Hey, and Mark, I'm just going to give a shout out to you and MIP on that. I work obviously all around the country. I know a lot of different providers and things are out there. It's pretty rare to find a company that has assets like MIP does, and that you're willing to say, look, when you're doing an exchange, let us know what your requirements are. Let us know how much equity you got, how much debt, and we'll try and look at our pipeline and our portfolio, and we'll try and carve out some of those for you and help you out. So just a huge shout out to what you do. I think that's really, you're being sensitive to the marketplace, and you're providing a little bit of an extra value add service by doing that. That is the biggest stress that people face in an exchange is, gosh, I'm going to sell here. Well, what am I going to go into? That's a very stressful thing. So I think the fact that you guys will do that and work with people in advance and try and line things up and accommodate that, man, that's a huge benefit. So kudos to you for that.
Yeah, no, our pleasure. I mean, like you said, the whole goal is to reduce the stress as much as humanly possible. And well, let's say you are in that position, all right? You're at day 45 and you have $1 million, deferred, delayed 1031 exchange, but you can only find $900,000 worth of property. So let's say you need to get that extra $100,000 worth of property, but you just can't find the house for whatever reason. What happens in that situation?
Well, if you don't find something else and identify within the 45 days, just that piece of it becomes taxable. So I sell for $1 million, I go into, let's say 900,000, and there's 100,000 left over. A lot of times that'll be extra cash that's sitting there. So we call that cash boot. And what's interesting, Mark, people sometimes think like, oh, I got into an exchange, it's all got to match up perfectly. 1/3 of the investors out in the country right now take some boot. So it's really common where somebody says, look, I'll sell an asset, I'll go buy a whole bunch more properties. And if the numbers don't perfectly match up and I have, 100,000 left over, you pay taxes on that 100,000, but the entire 900,000 that you reinvested is deferred. So in a way, you get the benefit, most of the benefit of doing an exchange, and you pay taxes on a little cash. Now you got that cash to do with what you want. So sometimes we have to educate people. It's not an all or nothing proposition, right? A partial exchange still offers a lot of tax benefits. And it's not that uncommon at all. In fact, very common that people do that.
Yeah, I mean, I love that there is a boot. I love how that is an option because the whole goal is to reduce stress and make it so that investor is not forced to buy a crappy property from someone just because they don't want to blow the whole 1031 exchange. You can actually focus on being selective and buying quality properties. And if you can't find enough of those, well, then no worries. That's exactly what the boot is for. So how much does this all cost? Let's say you have $1 million house in California. Well, how
Uh-huh.
do we have to pay you guys?
So every company's going to charge a different fee. There's no universal fee. Ballpark, you're going to look at somewhere between $700 to maybe $1,500 is kind of a ballpark. At our particular company, our fee is sell one, and you can buy up to three for $1,250. So our fee structure is really good for somebody that's going to sell one property and buy multiple instead of getting nickel and dime. Other companies might charge, let's say, $1,000 and then maybe $200 for each purchase. So if somebody's selling for $1 million, when they reinvest in the Memphis market, they're going to buy 6 or 7, right? So maybe each one of those is an additional 200. Which, Mark, what do you think of the benefit of an exchange deferring a massive? I mean, today the taxes are a lot. Everybody's properties have popped up in value, so you're deferring a lot of tax. So you pay a couple $100 per property, to get into more. It's a pretty small transactional cost where you get a lot of benefit out of it. And gosh, we see people doing that where they come out of the West Coast. They got a property's worth $1 million. They come into a market like Memphis and they can't believe the cash flow that they're getting, right? They're buying 6, 7, 8 replacement properties. The cash flow, let's say on I'll pick let's call it $1,200 per house roughly, compared to what they were getting so in California, they're making maybe $3,500 rent, but now they have 1,200 times 7 houses rent. They can't believe it. And you know what they do? I'm sure you see it. They tell their friends, hey, you guys got to look at this. Look what you could do. You could redeploy the capital and get a whole lot more cash flow out of it. And Memphis is a strong market, right? It's been a cash flow market, but it's been really strong the last few years on appreciation and it's been doing great. It's a phenomenal market.
Yeah, it's been exciting to be that hybrid market, but we are still that consistent linear market. We're not that boom or bust like you'll see in the San Franciscos of the world. And that's what makes it this nice, bedrock for being an actual investor. So then when it comes to other tax strategies, what else do you recommend besides doing a 1031 exchange?
Well, 1031 exchange is a great tool. You do it at disposition. So your choice is pay taxes, a lot of them. So you'd be paying depreciation recapture at 25%, federal capital gains at 15 or 20, depending upon taxable income, net investment income potentially, if you've got more gain, and then your state tax, which can be as high as 13.3% in California. So you add all those together, you got a huge tax bill. So that's where an exchange comes in, is now you don't have that tax bill and you redeploy it into more real estate. One of the things that we've seen, increasingly is that some people will do what's called a cost segregation study. The slang for it is called a cost seg. And they're doing them now on single family homes. In fact, Mark, you and I were chatting, I picked up quite a few homes last year and I did a cost segregation study on every single family house. And there's a benefit for me in that. And what you do is you get, the simple way of describing it is you're just front loading your depreciation. You're reclassifying a house that's depreciated flat, straight line over 27 and a half years. And now you're breaking it out into other components that could be depreciated at 5, 10, 15 years. So things like the ceiling fans and your refrigerator and stoves and all those things have a shorter lifespan. So now you get that depreciation up front. And as we were talking about right now, this year, you get something called bonus depreciation. So you can literally get 100% of that pulled up into this tax year. And I just think with inflation doing what it's doing, we could fiddle around with the numbers, whatever it is. We all know inflation's a lot, right? We go grocery shopping, we put gas in our cars, inflation's here and it hurts. this is a way that we can use the tax code to really front load our tax benefits today and take advantage of that depreciation in today's dollars and get that benefit now, which is really, I think, a smart choice.
Yeah, it's always a good option to be able to have a way to help with taxes at purchase. And so when it comes to the cost segregation, a lot of people will say, well, that's only for full-time real estate professionals or REP status investors. What about just the new investor that just wants to buy their first house or their fifth house or their 10th house, you know, that doctor, that lawyer? What do you say to them?
Yeah, certainly if you're a real estate professional, and that's a whole nother category, not smaller group fits into that niche, you get more benefit because you're able to take that loss and use it against active or ordinary income. What a lot of people don't know is the way the code is you've got some thresholds up to 100,000, you can write off 25,000 of that, which conveniently, Mark, you know, I find with the houses I'm buying, they're in that 100 to 150,000 category. You know, that's
Is
about
that
what I'm
purchase
getting in a
price?
cost
Is
saving.
that the number you're talking about?
No, purchase, let's say I buy for 150, and if I buy a house for 150, with the cost seg, I'll get maybe 25, 26,000 of depreciation. So interestingly, if somebody buys one house, right, they can use some of that without being a real estate professional. Now, it phases out between $100,000 in income and 150, right? So there's kind of a phase out where you get half of the benefit immediately. But, you know, not everybody's over that $150,000 income threshold. So if you're starting out as an investor and you buy one property, you do one cost segregation study and you get the benefit, that's a lot of tax savings. And guess what they can do with that tax savings, Mark? They can call up MIP and go, hey, I've just saved $25,000. That means I'm ready to buy another asset. And I'm sure you guys would love to help them out with that second purchase.
We would love to. We would love to. How much does this all cost? Like, do you have referrals for the company to go to?
You know, they're pretty nominal. Where I go use a company out in California and it runs about $400 a cost seg. I use software. So mine's software driven. I really kind of use the appraisal, property inspection as the tools to do that. I'm doing them as we were chatting about. I do them at home. It takes me less than 20 minutes to do a cost segregation study. So I'm spending $400 getting 20-some thousand dollars in write-off. Now, that's my depreciation. Remember, that doesn't mean I'm going to get that much tax dollars back. It's going to be 25,000 in write-off. Let's say I get 8, 9, 10,000 of that. But that's money that's positive to me right there. So, you know, you want to use the tools. I guess that's what's the beauty. Exchange is a great tool to keep building your portfolio. A cost segregation study is a tool when you buy it. You know, Mark, from watching investors through the years, the ones that really build portfolios and get larger, they're really savvy to using every legitimate advantage in the tax code to the fullest extent. And that sometimes separates those that kind of do a trajectory that goes up real fast versus those that just kind of go along at a slow and steady rate. So why not take advantage of things that are in the tax code incentives that stimulate real estate investment and provide a benefit to us as investors?
Amen. Well, the whole goal of, and one of the goals of Sofa Summit is to teach people how to scale, right? How to actually grow, how to go, instead of just buying your first house, it's how to go from 10 to 50, right? So why don't you talk a little bit more about your current portfolio? When did you get your very first rental?
I got my very first rental in 2002 because I got my first one. And, you know, it's a little complicated for me. I had an asset, went through a divorce, lost a few assets, you know, but I will tell you, you hit something really interesting, that word portfolio. You know, buying one rental is great. And you get, let's say, $300 cash flow, 200 or 300, whatever the number is. And it's a good thing. Where real estate gets exciting is when you learn how to scale it, right? So in my opinion, you know, I'm at 55, 58 assets right now. You want to get to 5 as fast as you can. 5's at a real sweet spot because you have one vacancy. You generally have enough cash flow coming in to kind of cover it. And so I go 5 and then 10. Now, a lot of people start at 10 or 20. They go, oh, the loans get more complicated. that's not that big of a barrier. Everything I do are what are called non-QM or non-QM loans, which are for the people that are at past their conventional loans, their first ones. Once you cross over there, it's actually really easy. You do pay a little more. There's a little premium on that. You got to pay more interest. But I do loans all the time where I literally just email my lender at midnight. Hey, I'm buying a few more assets. Here's what it is. I fill a little spreadsheet. I don't have to give them all my financials because I've got a relationship. So in some ways it's easier. So scaling and growing a portfolio, you can do it with single family assets. You can build almost what I would call like a REIT like portfolio. And the assets are little baby assets. So these little single family homes that everybody wants to rent. They're not going to really go down in value a lot. Let's say everything plummets. So Memphis goes down by $2,000, $3,000, $4,000, but not half of the value. It's right. And then you got the cash coming in. So I just think people miss the fact that single family rentals can be a great tool to build a sizable portfolio. And I just look at it as kind of stacking them up, right? You get one single family rental, get another, right? 4, you did, you went around the bases, rinse and repeat, do it all over again. And it doesn't sound too exciting, right? I don't have any bragging rights of some big fancy office building down the street, but gosh, with COVID, I loved having bragging rights, having single family rentals in a market like Memphis. Everybody wants those, and they seem to, and all sorts of economies gravitate to those types of assets.
Yeah, definitely. So I hear that you're working on a little program or course to teach people how to scale. Can you elaborate on that a little bit?
I am. I put together a course which really mirrors what I've done. So I started buying, onesie twosies and have grown a portfolio. And so I put together a whole course to show people how to go from 0 to 50 plus properties. And there are different skills along the way. Buying your first one's probably the toughest, but the skills in the middle to really scale it. There's some things that I've learned that I share. And there's some things I've learned, honestly, Mark, from my mistakes. I've made mistakes. We all have. So I actually have a whole section where I talk about, here's my mistake, right? I didn't do a sewer scope and it cost me a lot of money. And little things. And so, sometimes with real estate, everybody brags about their wins and, the great lifestyle, whatever. And I actually take the other, I'm like, God, I screwed this up. And boy, I botched this up. So don't do this because I learned the hard way. So really what I did is I just laid out for people what I did to go and scale and grow a portfolio and put that together. And then I've got a lot on the tax side for people that as they grow, they're going to need a little bit more of those advanced tools. So you were talking exchanges. There are things called reverse exchanges, improvement exchanges, reverse improvement. You can exchange air rights, water rights, so I go a little bit deeper on things that maybe people hadn't thought. You can exchange into oil and gas, believe it or not, or out of oil and gas. So I go a little deeper down the road for people that need more than just kind of that appetizer. They really want the main course. They want to sink their teeth into it and know how to do that. I just share from my own personal experiences, what I've done and kind of package that all together in a course.
That sounds incredible. How do we get our hands on it and get access to it?
You'd go to scottrsaunders.com. So just my name, scottrsaunders.com, and I've got it all there. And and by the way, Mark, as you know, I'm welcome to just field ideas from people too. So, if they're investors, just have questions. I do 1031s professionally. I'm pretty good at that. Been doing it for 35 years now, but I'm also an investor personally. I drink the Kool-Aid. I love real estate. I think it's a great asset class. It's overlooked. Some people always like, the Grant Cardones, you got to go apartments and stuff. No, you don't. Single family, just keep loading up little base hits here and there. And before you know it, in a few years, give it some time, you've got a really significant portfolio that does some pretty cool things just by scooping up single family homes, slow and steady. There's some, as you've seen, I'm sure with your clients, there's a magic that happens as you build a portfolio. And all of a sudden you look around, you're like, wow, it's got a life of its own. It's growing on its own with cash flow. It's appreciating. I'm paying down my debt. There are all these things working to your advantage there.
Definitely. Well, Thank you very much. That's all, we had today. I mean, what I take out of, being able to talk with you, and probably one of my favorite parts about a 1031 exchange is when I get to talk numbers to an investor that says, hey, I have $1 million house in California. What kind of cash flow can I get if I do a 1031 into Memphis? And when we have that conversation, they just go, wow. And that is just really exciting. That's really powerful to be able to provide that value and to be able to help. So if that is you, if you're interested in learning more, Scott, how do we get a hold of you?
Get a hold of me. 888-531-1031 is my toll-free number. Easy one to remember. My email, scott@apiexchange.com. So A is in Apple, P is in Paul, I is in Igloo, the word exchange.com. And you know what? Anytime, just whether you have an exchange going on or not, I answer questions. I can't give tax or legal advice, but I'm happy to give you some input and let you know what the rules will allow you to do and what you can't do. So happy to help out. And, you guys at MIP, I got to tell you, you're a class act. You just do a great service, provided a great product for investors. I love your newsletters, how you share sometimes what's going on in the market. So being a remote investor, I'm here in Colorado, as you can see behind me. I love hearing you share what's going on in Memphis and maybe an investment over here. So you do a great job of not only providing a great asset and the property management, but then just keeping us informed. I feel like I'm connected to the Memphis market, even though I haven't visited the market for a number of years now. So thanks for all you do.
Yeah, well, that means the world. We appreciate you as well. So everyone out there that's listening, hope you found a lot of value. Please just give Scott a call or an email, even if you have a couple of questions. He's very accommodating, and we'll see you for the next session. Thanks, guys. Hey everyone, welcome back to the next session for the 2022 SOFA Summit. I'm pleased to introduce our upcoming speaker, Ramez with the IRA Club. Ramez, how you doing?
Mark, can you believe it's been 3 years? 3 years. This is your third SOFA Summit. I'm really impressed and proud of Memphis, everything that you guys have accomplished. Our 4-year relationship, going close to our 4-year relationship. It's been smooth and super happy with everything that's going on with both parties. IRA Club has definitely thrived after this pandemic. And we're going to get into the reasons why in a split second.
I love that. Yeah, it's all about relationships in this game, that's for sure. So one of the biggest bottlenecks and biggest hurdles that our investors ask us on a daily basis is how can we find more capital and get access to more capital so we can acquire more properties and scale and grow our rental portfolio. And one of the biggest misconceptions and one of the best places to access that capital is sitting right in front of most Americans, utilizing your retirement funds, your IRAs, your 401ks. And there's a lot of misinformation, misconceptions about the 401k, about the retirement IRA industry. And a lot of that education is flawed. Once you actually look at the numbers, look at the data. And that's exactly what Ramez and the IRA company is going to teach you, is how you can actually take control of that capital, of that money, and utilize it in a better form to get a higher return at the end of the day. And so, Ramez, why don't you take it away?
As I'm jumping on the screen, you said a word, and that word is control. And that is what we're ultimately here to try to educate, not just IRA Club members, but everybody that does have a retirement account, is the power of a self-directed IRA. And just before I jump into that, Mark, a little bit about myself, Ramez Pkwy, Vice President. I've been here for 8 plus years. My wife has been here for 10 plus years. Started by Dennis Blitz, 2008. Very well-respected man within our industry. Just a little bit about our company overview and who we are. We've been around again for 15 years. We administer just under 12,000 IRA Club members. We manage $1 billion in assets. We have 35 full-time employees. But to learn a little bit more about who is IRA Club, because again, Mark said this to the T, is like people just do not understand or may have heard of a self-directed IRA, but just don't understand it. And what are the rules and regulations behind them? And within our industry, self-direction is a marketing term that we use, all right? Self-direction, I'm going to say this over and over again, is about one thing and one thing only: control. So our vision is to always educate our clients. One of the reasons why I love Mark and his team at Memphis, education is one of their forefronts. It's one of our foundation pillars here at the IRA Club. And then our mission is just to open doors and opportunities, right? To educate, inspire. And that is all we're ultimately here to do, because this bothers me. Mark, I know you've seen this chart once before, and it hasn't gotten any better. All right. If there's 64 million IRA accounts across the country, of which, better yet, 60 million have $1 million or less, and only 1.8 million IRA accounts have $1 million or more, I always ask this question: what is the 1.8 million accounts doing right that the other 60 million accounts are doing wrong? And the answer is so simple: they're self-directing. That's it. Okay. And the other thing you need to understand is you cannot save your way to retirement. You have to invest your way to retirement. So how can you close that gap is the question. And that's what we're here to educate you on, right? But understanding the individual retirement account and how it came to fruition is just as important. All right. And my personal opinion, Mark said this: how did it get hijacked, and who hijacked it is the ultimate question. So established September 2nd, 1974, it was really, in the beginning, Congress used it to address pensions. Less and less companies were offering these, even back in 1974. So what ended up happening was, what do we do? How do we address this? They created an IRA, a way to grow your retirement account, tax-free or tax-deferred, if you utilized it for investing purposes only. However, it wasn't until later that they realized that pretty much every government program that we have for Medicare, Social Security, and Medicaid is completely broken, right? Just last year, $2.2 trillion was part of the bailout or the stimulus package that the government had to do because of the pandemic. Today, it doesn't get any better, right? So we're looking at the average IRA or 401k or 403b, I'm talking about all qualified retirement accounts, only have $40,000. Now, obviously that grows as each decade goes by, but most people are dependent on their social security checks, which is only $1,500. After taxes, you're looking at somewhere about $1,250 to $1,300, depending on where you live. So the funny thing to me is, can you live off of that? And most people this day and age, especially where inflation's at, cannot live off of $1,250. Now, to add more fuel to the fire, if you take a look at when Social Security was first established in 1935, there were 24 workers for every one retiree. That number today is 2 to 1. They estimate by 2030, that's going to be 1 to 1. So there's going to be some major changes happening within Social Security within our lifetime. Otherwise, you could forget about it. Not to mention 28% of Americans over the age of 55 don't even have a savings or retirement account. This is where the majority of the US wealth within retirement accounts sits. It's within the Gen X's and the baby boomers. If you take a look at millennials, 4.6%.
Millennials.
Good job, Mark. Great job, Mark. Way to contribute. But I know that you're not that person because I actually see your contributions. So good for you, good, and the family. And by the way, congratulations on the baby. We'll talk about that later, because you need to set up a Roth IRA for your kid the day they are born.
There we go.
And we'll get into that another day. But for now, let's get back into it. Adding icing to the cake, taxes and inflation. We all, none of us need to be living underneath a rock to know where inflation is. In fact, the report just came out for the month of July at 8.5%. That's not that big of a help. Finally, yes, fine. It is cooling off. It took three interest rate hikes by the feds, but my personal opinion, too little, too late. Inflation's here to stay. It isn't going anywhere. We put $13 trillion into the economy. Fun fact, Mark, did you know all wars in the US have tallied up to $11 trillion? All wars since the United States has came to existence is 11 trillion. So we printed more money these last 2 years than all wars combined. I mentioned where CPA is at. The cost of living across the board has gotten much worse for everybody. I mentioned the average household income is just north of $500 per month. That's $6,000 more per year. You need to figure out ways how to benefit or better yet, excel or accelerate your growth, because it hasn't matched with the labor. I believe also at 6% across the country has been the general growth or what they've seen. But again, if inflation's at 8.5%, you're still in the hole. So if inflation's here to stay, what do? You got to use it to your advantage, right? And the way to do so is self-direction. You have to ride the inflation wave. And to do this, it's through diversification, right? You cannot have that mindset anymore of set it and forget it for the next decade. Because again, most economists are thinking inflation for the next even 5 years is going to hover somewhere between 5 to 6%. So with that being said, that's the way to ride it, is the alternative space, hard tangible assets, such as a house on 123 Green Street. Taxes. Now, we're heading into a tax storm. I hope everybody realizes this, because for the first time ever, the Biden administration and the Treasury Department are in full support of each other. But as investors, we need to be aware of this, right? We know that corporations are going to get hit the hardest. In fact, I'm pretty sure that everyone's heard in the last few days to battle inflation. They're talking about raising corporate taxes at 15%. But as an investor, somebody like me, you're talking about getting taxed 62% on my earnings. So I am looking for every possible path to defer money away from who? This man. That is the $1 million question that we receive here at IRA Club, is how do you get rid of taxes? This is a strategy. Self-direction is a strategy, because taxes will never be as cheap as where they are right now. That is the ultimate truth, okay? Not to mention, remember, we live in a progressive income tax driven country. It only goes in one direction. It's up. Now, I want to go back to this real quickly, Mark. And this is funny because as part of the new program that they're looking to battle inflation, the Inflation Redemption Act, it's funny because they said that they're not raising the taxes across anybody who's making over $400,000. But what are they doing? Because me and Dennis, president of IRA Club, had this funny discussion yesterday. Okay, let's go ahead and let's give, better yet, the IRS $80 billion. Let's give them an extra 87,000 IRS agents to go after who? The middle class. So although, Mark, they're not going to tax you, they're going to audit the living, excuse my French, hell out of you. So just be wary of that. But this still falls back to retirement and retirement accounts. If you know that every single thing is working against your retirement, if you know the market is at its worst start for the first 2 quarters in the history of, since 1952, I believe, or 1950. But if we're looking at that, if we know that taxes are on the rise because they have to come up with $4 trillion of gross revenue in the next 10 years, if you know that every government program is broken, okay, and inflation isn't going anywhere, you must diversify your retirement account. Dennis refers to this as the gift that keeps on giving. I refer to this as the most underutilized gift that Congress has ever given you. Remember, all retirement accounts are self-directed across the board. The benefits of retirement, self-directing your IRA or your 401k is control, taking back control to invest in what you know and understand best. You have to incorporate real estate within your retirement. Mark, what has never dropped, I believe, in the last 20 years? Rental income? Has rental income in Memphis ever dropped in 20 years or even 30 years?
It's going up. Okay.
especially with
Thank you.
inflation.
And oh, thank you. Why is that? Because inflation works in your favor. That's fantastic. Now, you said something to me that I was blown away by when I asked you, what's the appreciation year after year in Memphis for the last decade?
For the last decade in Memphis, appreciation 6.11% year over year over year over year.
Year over year over year. So let's hear this again. 6% year after year appreciation. Inflation is now working in your favor at 8% outside of the stock market. And then you have your rental income that has never dropped. Has never dropped in the last 25 plus years. I shrug my shoulders. So who's in the driver's seat? It ain't you. Americans, only 3% self-direct. 97% of the rest of them put their money in three places: banks, annuities, and the stock market. All right. And in particular, when it comes to the employer's 401k or 403b, 457, you're typically looking at annuities. And we're going to get into that a little bit later. Today, Goldman Sachs, actually yesterday, I looked this up. Anybody could go Google this. The best CD rate at a 12-month span is 2.2%. I don't even want to talk about that. Nobody that is even listening to this should be looking at 2%. Annuities. I will talk a little bit about this because annuities are targeting people that are traditionally that are looking at retirement within the age brackets of 50 to 60. Why is that? Because you cannot touch your employer's 401k, but you can roll that over into an annuity. There are two different types of annuity. There's a fixed income annuity and there is a variable. We're going to talk about the fixed in particular. So I want you just to be wary of it. At the end of the day, this is educational. You do what's best for you. You do what's best for your family. The stock market, we all know where the stock market's been hovering for the last 10 years, around 8%. If you're looking at 15 years, it's about 6%. I think those numbers are a little bit skewed. But talking about annuities, their solution is real simple. You'll never have to worry about the stock market. Assuming you're the age of 55 years old, and let's just say you have $100,000 and you're thinking about retiring and you're terrified of the stock market and you've already lost your 20 or 25% and you think it's going to get worse, that is where annuities are marketing to people in that age bracket or larger institutions to roll those funds over. So you are guaranteed a 5% for the rest of your life, right? My personal opinion, these are the issues with annuities. Most people do not know this. They are the most profitable for the actual insurance agent, upfront commission-based. Now, not to mention that most of them are salespeople. They don't really understand what are within these packages. Annuities are not, I repeat, not FDIC insured. God forbid something happens to the company. What happens to your retirement? Gone. They're very, I'm sorry?
Yeah, goes away.
Did you
goes zero.
Did you? Oh, I'm sorry. I didn't even know if you knew that, Mark. But yeah, they're not FDIC insured, such as an IRA or 401k. But they're very high surrender charges. You're not in control. The key word is you're not in control because most annuities are still tied back into the stock market, even though they're giving you your 5%. But what's funny is they're making money on your money. That's exactly what they're doing because they know that they could hit 5% with their eyes closed. That's the truth. But let's take a look at the numbers real quickly. Let's just say you are 50, 55, 60, approaching retirement. You are terrified of the market, or you are over the age of 60 and you happen to roll over into a fixed income annuity. These are the payouts. So if you roll over $100,000, let's say hypothetical, we keep using the $100,000, you are guaranteed $421 for the rest of your life, assuming you live until 78 years old. Because that's the average age. I believe it's 78.8 to be exact. But the point that I'm trying to make is nobody could live off of $421, especially now. All right. We all know that, Mark. That's why you're smiling. Mm-hmm. Next, I call these the four horsemen within our industry: Fidelity, Vanguard, Schwab, TD. They control just under 70% of all retirement accounts. Of the $33 trillion, they control just under 70%. Fidelity being the forefront of this at 33% of all qualified retirement funds. And the reason why I bring this to your attention is this just bothers me right here. It's the truth. And I want people to be aware of these, that if you are tied into a 401k, right? Or better yet, better yet, not that you're also tied into a 401k, but you happen because this pandemic has changed a lot of people's lives. Just this last year, 22 million people have changed their jobs. And I would say about 78%, I believe was the number, had old employers' funds. And the majority of them were approached by Fidelity, Vanguard, and Schwab and say, hey, you could roll it over to your new employer, keep it there. We'll take care of it for you. But they are designed, 401ks, whether it's an employer's 401k or if it's just sitting there from your old employer, are designed to benefit them, not you. Told you, control is the name of the game, and they do this by creating artificial restrictions. This leaves you always misinformed, misguided, and you always lose an opportunity. Mark, I want to use you as the perfect example because that's the one thing IRA Club cannot do. We open the accounts, we fund the accounts on behalf of our clients. The only thing that we can't do is choose the investment for the investor. It defeats the purpose, right? We're talking about control. Otherwise, you could go ahead and leave it at Fidelity, Vanguard, and Schwab within the stock market, whatever the case may be, right? So with that being said, let's just say you have an investor and you educate them also on self-direction. They have a 401k plan, a couple $100,000, and you say to them, and they have, better yet, a registered investment advisor, and you test them because I've seen you do this before. Go up to your broker and you say to them, I found a house on 123 Green Street on Memphis, and I would like to use a portion of my retirement funds. And they're always going to say that isn't part of the portfolio. That isn't what we have within the brokerage firm. But these are other options that they have. That's the way they look at it, because at the end of the day, that's how they make money. And who's taking all of the risk? You. Always remember that. It's always you. And typically it's always within a fund portfolio, as I just mentioned. The only time that you earn money is when the market's up. That's it. Do they make money if the market is flat or down? Yes.
They do. Yep.
Yes. I need you to be aware of that. The only time you make money is if the market is up. And for every $100,000 that you traditionally have, it's typically between $2,000 to $3,000. And we're going to get into that fee structure a little bit later. But again, what bothers me about you taking all of the risk is not just the fact that you're taking all the risk with your money, you're adding longevity. So sorry, you're losing time. Forgive me, I meant to say time. You're losing time. So let's just hypothetical say there've been 12 recessions in the last 50 years. All right. Assuming you're 60 years old, Mark, assuming you're 60 years old, I'm so sorry. Assuming you want to retire, let's backtrack a second. You want to retire at 60. And I'm just taking these recessions within our lifetime, right? You would add on, if you're approaching retirement, 1.6 years. If you happen to have a current employer's 401k during the .com or tech bubble, you would add 4.6, which means you would retire at 64.6, just for you to get back to even, because it doesn't take days, it doesn't take weeks, it doesn't take months, it takes years just to get back to even. Imagine if you took a portion of those retirement funds and invest on a house on 123 Green Street, or a house in Memphis, or a syndicate.
Exactly.
Right?
Yeah, because the fun fact about the way real estate performs during a recession, real estate actually went up for 4 of the last 6 recessions. And that's fascinating. It actually increased in value during 4 of the last 6 recessions. And on one of those recessions where it actually went down, it only went down 1.9%. Abysmal. So we really only had one bad recession. And what was that? 2008, the Great Recession. But on the other 5, it either increased or was abysmal. And that's fun. That's power at the end of the day.
But Mark, 2008, 2009, forget about that 1-2%. What didn't drop?
Rents. There you go.
The market's got a pattern. All right. This is the longest it's ever been. This streak of 14 years is the longest. It's always between 8 to 10 years. There's always a correction within it. This is we're overdue for one, bottom line. But the point that I'm trying to make is, if you took your IRA funds, because if your IRA is buying that house, or your solo 401k is buying that house, or if you use a portion of your retirement funds to buy that house, Mark, what do you have? God forbid the house burned down.
What do you have? Insurance?
Thank you.
Yeah.
Insurance.
Insurance.
So how long does it take for you to get your money back within, if you have insurance, homeowners insurance? 30, 60 days
Go through that whole policy. Yeah. A couple of months.
versus
You could get paid
years.
back. You could get paid back in full. Yeah.
But that's the point that we're trying to make right here is diversification. Protect yourself against market volatility, because real estate, you should always have a portion of real estate. I love real estate. I understand real estate. I know how to operate. I know everything and anything about it. So real estate is such a forefront of the way that I look at retirement. But for another story, concerns
So that's also
that I
powerful about the benefits of real estate having insurance, because you were talking about before annuities, they aren't FDIC insured. Since they don't have that insurance, if something goes wrong with that company, your retirement account is now zero for that said annuity. For something like real estate, that bad boy burns down, you have a great insurance policy. You could either rebuild or just sell it, or just take the insurance money and run at the end of the day and just sell the land.
And 1,000%, but within annuities, and just to fall back on annuities, it's not just the fact that it's something the FDIC insured. Ultimately, they win. You need to understand how the fixed income annuity is structured. Why is that? God forbid you step outside of the house and you get hit by a bus. They ultimately win because they get your money. You need to make sure that the structure of the annuity, also some of it is going to your family. That's the beauty of a Roth IRA or any IRA as a whole. They get passed along to your heirs. You don't have to worry about that. So just keep that in the back of your mind also when you're looking at such things like that. But concerns that we see here at the IRA Club day in and day out, the truth is lack of knowledge. I mentioned most people do not understand that they could even do this, or they may have heard of it, but they don't know how to act upon it. So that's what IRA Club does for you here. We're a full administrator. We're here to educate you. You're assigned an IRA Club specialist. We're going to walk you through this whole process. Me, you, Mark, and the Memphis team and our team, that's what we do here. But the other one that makes me laugh is, am I too old to get started? You're never too old to give Uncle Sam the boot. I just told you live until 80. Did you know that you and or your spouse collectively, if you don't smoke, drink, eat, none of those things about me, because I fail in all categories right over there, and don't laugh at me, Mark, but I fail in every category there. But assuming that you do those, that one of you that will live until 85 years old, believe it or not, is 67%. Keep that in the back of your mind. So you could pass those along, those retirement funds, tax-free or tax-deferred, to your heirs, your spouse, your kids. Risk. Everything's got risk. Every investment's got risk, right? Anything that you do has got risk, but it's taking educated, calculated risks, right? The stock market, we're going through it. We're in the middle, right now. You're going through it right now. So the point that I'm trying to make is taking educated, calculated risks is the way to go. But for me personally, it's just everything and anything. Again, I keep repeating this. It's the control aspect for me. You got to take back control of your retirement. All right. And this is the only way you could really do so. There are a couple other strategies, which I'm more than happy to walk you through. But lastly, these are the things that we also hear is my fiduciary broker, my registered investment advisor said, don't do this. It's too risky. You're going to regret it. That's where the risk factor, right? But that's where the risk factor, Mark, comes in. And at the end of the day, they still have to earn a living. I don't have anything against a fiduciary, a broker, or a registered investment advisor when they're working in your best interest. The problem is, you get attached to them. They become your friends. You're inviting them over to your kid's barbecue, a barbecue, your kid's birthday party. You become attached, and it starts to bother you to. But if they are a good fiduciary, registered investment advisor, and you say hypothetical, I found this house on 123 Green Street, Mark, they should say, well, here's an option. You can self-direct it, but you need to find a custodian or an administrator that does this for you, such as the IRA Club. That is a good fiduciary registered investment advisor. But remember, it's about fees. It's always built within fees. And the problem is most Americans, 58% of them, don't even know that there's hidden fees on the back end of your employer's 401ks or 403bs. In fact, only 8% of Americans actually know where to find them, look for them, and calculate them. But this is important. I need you to understand these are the 5 most common that are worked within these statements, right? They're hidden fees. They're not expense ratio fees because as of 2020, the Treasury Department has asked to fully disclose the expense ratio fees and/or management fees, but these are still worked into the statements, and they typically tack up to be still around 2 to 3%. This does not include your expense ratio fees and/or a marketing fee if you have one. All right.
And that's 2 to 3% of the total portfolio value. You got $100,000 in the portfolio. That could be $3,000 per year. Ouch.
You just took the words right out of my mouth. So think about that. For every $100,000 that you have in your current 401k, at bare minimum, they're taking $2,000. So if you have $500,000, they're taking bare minimum 10 grand. And tell me a slap in the face. The market's down 20%. Okay. So if you had $500,000 and it's down 20%, you're down to $400,000. Did they still take their 2 to 3%? Did they take their $8,000?
Oh, yeah.
Of course they do. How do you think these institutions control $30 trillion? And the reasons why they don't like IRA Club, because we're giving it back to the investor. Our fee structure is flat. There are no percentages. We don't want, what we're looking at is, I don't care if there's 10,000, 100,000, or 10 million in your IRA account. It is an annual 175. We are the administrator. We are helping you, making sure that you don't cause any prohibited transactions. We're walking you through the whole process. Do we have checkbook LLCs? Yes, we have those. We're more than happy to open them up. My personal opinion is 80% of the time, somebody screws it up, right? They cause a prohibited transactions. We have them. We could set them up for you, but why do so as us being the administrator? Full disclosure, we make more money at the end of the day. I'm not trying to make more money. I'm trying to help you. The IRA Club is literally walking you through this. Per asset is where we're making our money. It's $135 per investment opportunity. If it is a hard tangible asset, like a house on 123 Green Street, it is $175. There's a lot more paperwork involved, as Mark will tell you. But the point is, it's a flat fee model. We're not making money as you make money. Again, that is the point of this. But let's break down that number. Let's take an actual.
If I just understand correctly, if you go back to those fees. So now we'll go to the IRAs. Yeah, right there. So let's say you have $100,000. You buy one house in Memphis. You have your 175 annual to get set up, plus the per asset, which you said was a little bit higher. That's per year, right? So we're talking max $300-400 max, when traditionally we were talking $2,000 to $3,000
per hundred.
Yeah,
per hundred.
For $100,000. That's
so. But let me backtrack 1 second. You also have other investment opportunities, right? This only applies to hard tangible assets. But let's just say you have a syndication. It's 135. So and the more investments that you do, so if you get to 5 or more, that actually drops down to $95. So again, I'm not trying to make money on you year after year per investment. We actually give you a discount if you get to 5 and more, because I want to practice what I preach here, right? Amen. That's the name of the game. Amen. Diversification.
It seems like common sense. You have the $2,000 to $3,000 per year in fees on $100,000, or $300 to $400 per year on $100,000.
Look at this chart. Mark, let's look at this chart. Let's just say, knowing that everything's working against you right now, let's just say you have an IRA with Fidelity, Vanguard, or Schwab, or an old 401k. Let's just start simple. I use everything simple. 100,000. If you heard me say 100,000, that's all I'm using. $100,000 for the next 10 years. So you don't have that mindset of set it and forget it anymore. And the annual contribution is $6,000. Why am I saying 6,000? Because truth be told, the average American only puts 6% into their retirement, okay, year after year. So with that being said, if your annualized rate of return is 10%, I just said to you that IRA Club is charging you $300, right? 0.3% versus Fidelity, Vanguard, Schwab, TD Ameritrade, one of these other 10,000 brokerage firms, or you have a fiduciary charging you maybe, the hidden fees and his 1% or 50 basis points. You're talking about saving in a 10-year span $93,000. IRA Club is going to save you $93,000. Keep that in mind.
Fees alone, massive.
Right? Think of just the fee structure alone. That's it. But let's take it a step further. taxable versus tax deferred versus tax free, right? Traditional is tax deferred. Okay. The two most common retirement accounts are traditional Roth, right? Traditional IRA, Roth IRA. Traditional 401k, you can't do a Roth 401k, right? The only differences are they're all governed by the same set of rules and regulations when it comes to investing. It's just how much can you contribute and when do you pay the taxes? That's it. Deferred, you take the deduction up front and you pay the taxes later as part of your RMD after 72. Roth, you pay the taxes up front and then you pay, and you will never pay taxes on the capital gains moving forward.
Hence
I
why
am a huge
Roth
advocate.
normally recommended.
And it's always recommended because think about it. If your returns on investment year after year is 12%, and let's just say you're in the 30%, 30% tax bracket, right? Hypothetical. By the third year, actually 2.5 years, because we're talking about Memphis and your investments are, and I'm being conservative when I say 12%, because I do know your numbers. I can't see them. So we're being conservative at 12%, but let's just say 12% by the 2.5 year, you have basically paid off the taxes. Everything moving forward for the rest of your life, your spouse's life, your heirs is tax-free. That's why I'm a huge advocate of the Roth. And get your kids involved in your deals. I keep saying that over and over again. I'll give every kid here a free IRA account on me. Just get them involved in your deals. It's a difference of not hundreds, but millions. The earlier they start. But let's go back to this. I'm going off subject. I'm sorry, Mark. I know you love that about me. Taxes versus traditional versus Roth. Let's use your numbers, Mark. Am I conservative when I say 12% in a 10-year span within real estate year after year?
Yeah.
10 years.
Take a all cash purchase, so the cap rate, and then plus appreciation, 12%.
So, okay, let's keep it realistic. So 12%, and I know that's an easy number to hit within real estate in a 10-year span, $100,000, same numbers. You're still contributing your 6%. Take a look from your own personal funds versus traditional versus Roth within a 10-year span, right? So if you took money from your Chase account or Bank of America account, you would only make $343. Deferred, traditional, $422 versus Roth, $478,000. This is how you get ahead of the game. These are what savvy investors do. Traditionally, people in the 32% tax bracket or higher. Not only are you making that, so I'm actually just wrote down these numbers, believe it or not. Now you're making within a Roth IRA $135,000 in tax savings on the $100,000 investment, plus IRA Club just saved you $93,000 in fees. That's how you accelerate your retirement account. Jesus, I stuttered. Sorry about that. What is the process like? This is not difficult. This isn't rocket science. I promise you, if you could do this just one time only, you won't even need to call IRA Club anymore.
Get the phone out.
Thank you. Scan the QR code. We built this landing page strictly for Sofa Summit for Memphis. Open, fund, invest. That's it. To open your account, if you like, scan the QR code. It'll take you straight to the landing page. It'll say, start my account. In order to get started, you need 3 things. A government issued ID, it could be your driver's license, state, or passport. Name a beneficiary, always name a beneficiary, and all I need is your social security number. Second, funding, contributions, right? IRA to IRA transfers, old employers plans, contributions. If you're under the age of 50, $6,000, over the age of 50, $7,000. IRA to IRA transfer, IRA Club will do the work for you. So if it's a contribution, IRA to IRA transfer, pensions or annuities, IRA Club will do the work for you. The only thing that we can't touch right now are the old employers rollovers, because by law, we can't touch those. That will change 90 days from now, as Mark is well aware of. But at the same time, we will give you a step-by-step guide, all right, as you open up your application and then invest. Simple as that. Open, fund, invest. Scan that QR code if you haven't done so already, because, again, I'm going to practice what I preach and I am going to give you a promo code, and I'm going to waive the first year. Put in the promo code Memphis, find your investment opportunity, go educate yourself. You could scan this QR code right now. It'll give you direct access to IRA Club, to me. Schedule a call, because I know everyone's, goals and situations and type of retirement accounts are different from the next. All right. We'll never put you in a retirement account that doesn't make sense. In fact, if you qualify for a solo 401k, I'm always going to put you in a solo 401k. Truth be told, only 10% of Americans qualify for a solo 401k. That's why I really don't bring it up that often. But this would give you, when you scan the QR code, you could exchange your contact information with me, and you could take you straight into my calendar link. You could also start an account, go to the website, events, LinkedIn, Google reviews, and everything else that you need is all within that. So, Mark, I hope this was really, really educational for everybody. I'm passionate about it, as you could see. It just bothers me when people can't really do much with their, their retirement accounts, especially if it's with their current employer. We're just here to help at the end of the day. So keep that in mind.
I love that. Thank you very much. I mean, what absolutely blew me away, and what I challenge every single person listening to the SOFA Summit right now, is if you do have a 401k and an IRA traditionally through the big dogs, figure out what fees and what expenses you're actually paying on an annualized basis. Because like that stats that only 18% of people actually know what those fees and expenses are. And it's a no-brainer, right? Do you want to pay $2,000 to $3,000 in fees on $100,000 traditionally, or call someone like Ramez and just go pay $300-400 per year? The savings are absolutely immaculate, and it's a lot of information, right? But that's the best part about their whole pillars and values, is on education, why he does these. And all it takes is a quick phone call to figure out if it's a good fit for you.
At the end of the day, Mark, it's just because people are, and forgive me, they're just, number one, unaware. They're not educated on the topic. They may want to get started, but the problem is most people that do have these retirement funds cannot identify the investment opportunity. Staring you in the face is what I'm trying to say. So I just can't choose it for you. Ultimately, that's up to you at the end of the day. That's the beauty of a self-directed IRA. One last time, control, control, control.
It definitely is. So if you guys are open to taking more control, please, please, please follow through and contact Ramez. If you need his contact information, you can always reach out to me. I'm more than happy to get that to you. And hope you guys enjoyed this session, and on to the next. Thanks, guys.
Pleasure, everybody. Take care.
All right, hey guys, Sean Taggy here. So we are actually in a new city that we've expanded into in 2022, and a new state as well. So we are in West Memphis, Arkansas, and we just started this year and decided to move into West Memphis and do a few turnkey flips over here, so we can have some more inventory for you guys to buy. West Memphis isn't that far away from Memphis. We're about 30 minutes from our office, just west of the Mississippi River, so just a skip away. Not too much of a difference here. I'd kind of compare it to like Raleigh, Frazier, Whitehaven type of feel for these neighborhoods. And so yeah, we're here at one of our first properties we just bought. It is 406 West Bond Ave, a 4-bedroom, 2-bath house built in 1967. So let's go on inside and check it out. On the exterior here, we're going to be replacing a lot of this rotten wood and painting the trim and the fascia underneath, repainting the shutters. We're going to replace the roof that is old and outdated. And excuse us here, we just got our crews here. Excuse me, come on through. So here's kind of the den area. Okay, so here we're at the kitchen area. And so the kitchen, we're just gonna be replacing some of the cabinets and painting over it, replacing some of the fixtures, new Formica countertops, everything like that. Obviously painting throughout the whole entire house. Here's another room we have. Hey, how's it going? We've got our crews in here already. So this room will be refloored and painted and everything like that. This is kind of like a little bonus feature. I think this is kind of nice once when it's all renovated and completed. So we have, this is a dedicated laundry room, kind of nice and big too. You know, we'll kind of demo out some of this uglier looking stuff, but this will be a nice laundry room, you know, kind of separated from the house, right off from the parking lot. So the driveway on this house, and then also a little storage slash, could be an office area over here. And then here, you can come out here and kind of check out the siding of this side of the house. So we have a lot of money on our budget to replace all this old, nasty, rotting out, peeling, you know, paint chipping off siding. Okay, so that'll be a lot of that on the budget for these shutters and other things like that, just to make the house look nice and fresh and obviously weatherproofed and safe. So coming along through here, we've gone through the kitchen already. So here's one of the bedrooms we'll be renovating. Obviously there's really old stinky carpet in here throughout. We'll be replacing all the floors with luxury vinyl plank flooring so it won't smell anymore and as easily. So here's kind of a Jack and Jill bathroom. We're fixing this up and renovating it, and look forward to showing you the finished product. And then here's one of the other bedrooms. So it's a 4-bedroom as mentioned. So here's another one. And then you have 2 more over here. Right there. And there. And then this bathroom as well will be, you know, remodeled as well, looking all nice and fresh. Here's another thing you're going to want to see. I'm going to open this up for you. You got the furnace looking really, really old, so we'll be replacing that. Now I made a circle around here. So that about consumes for the beginning portion of this property. As you can see, it's a war zone over here. We're renovating a lot of things in it. This will be looking a lot prettier when we're finished, and we look forward to showing you guys that. Thank you so much.
There we go. We did it. Day 3, Sofa Summit comes to a conclusion. Appreciate everyone that is out there still. Hope you guys found some incredible value that you can actually implement as an action item. Man, I really love the apartment syndication talk because it's great to diversify your real estate portfolio. That's what we do ourselves, right? That's what you guys should do as well, is grow the single family, grow the apartment syndication. Everything has its own pros and cons. So we're here to have that one-on-one consultation with you to really figure out what's the best opportunity for you to fit your needs and your goals.
Yeah. So thank you so much, guys. We appreciate you listening and watching this YouTube channel, and also everyone that's invested with us, whether that's with a single family or joined on in one of our multifamily investments. We're super happy to have you with us. It's been so fun listening to each person, kind of their stories, why they're doing this, and all the experience and knowledge we've learned alongside with you.
Definitely, definitely. So final shout out to our sponsor, CLOSETRAK, and Greg Ziskin. Y'all are rock stars. Thanks for making this whole event happen this year and this day. We're really excited. So if you guys have any questions, any comments, but also any feedback, please let us know. We'll be having another one of these next year. If there's anything that we left out that you guys would like us to dive into, please let us know. And if you haven't done yet, smash that subscribe button, join our buyers list, and hopefully by now the comments are concluded. So we will reach out to everyone individually for the winners of their Yeti, get those shipped off, and man, what a good time.
Yeah, we'll see you guys next year on your way to financial freedom. Have a good one.